Yes, now everything should be fine. And so let's start this part. Okay, so today we will study company analysis, past and present. So this is the first step of equity researcher's job. So if you get the job of an equity researcher, then you will have to do all the activities of this part, and then in fact the entire one after this next chapter, then last until last chapter, that all are the steps that an equity researcher is supposed to do, though not always required to do, because something is not applicable. Like if it is a small company, then uh, that might not be applicable, some of the steps. So let's do what steps are required. So first of all, the investors don't know anything about a company. If you are covering it for the first time, then your investors obviously don't know. So you have to give detailed analysis about the company, and we will come back and solve these questions at the end of the chapter. So once we finish it, our learning, then we will solve all these questions. So how to get the information about company, uh, and how to prepare the research reports. So we start with preparing the company research report, and this will be the first version. Subsequent version will not be repetition of what has been the first version or initial version, but subsequent version talks about changes or inclusion of updates that have been added to the past information, and based on the new information, you will have this risk evaluation, means new risk report, and then the return, means whether based on the return you recommend buy, hold, or sell. So these two things, the recommendation of the analyst and the risk, updated risk, all these are common to all equity research report. But the first research report will be much more comprehensive, giving the competitive position of the company, industry analysis, then the Michael Porter's 5 powers, detailed description. So all these will be in the initial report. So what do analysts do? Analysts value and make investment recommendations on issuers' equity securities using scenarios of future earnings, cash flows, and financial position. So it is the discounted cash flow statement, discounted value of free cash flow to the firm that determines the value of the firm. So definitely these cash flow analysis will be done in cash flow statement. Then future earnings, then definitely it will be the current revenue and projected revenue. So in income statement, and financial position is in the balance sheet. So these three financial reports you have to start with as an equity analysis, as an equity analyst, and then the current one gives 1 point, means one scenario, whatever the current scenario is, it gives the position of that. Then a point estimate has very low probability, close to zero, that we have studied in normal distribution or any distribution. So we give interval estimation. And that interval estimation contains a scenario, means one standard deviation below will be what? Scenario of a recession. Two standard deviation below will be scenario of depression. Then once a standard deviation above, boom. Two standard deviation above, too much inflation. So means, well, one standard deviation will be the scenario of mild inflation, then two standard deviation scenario of too much inflation, and that will be bad for the economy, because the government, especially the monetary authority, will start in reducing money supply to contain inflation, and that will be uh, bad for the company future growth, and also future, even the current revenue won't be able to maintain, won't be able to be maintained. So that way, this using scenarios of future earning, cash flows, and financial position, then so all these scenarios will be analyzed, and then based on that, what is the best average income? Because the current scenario might not be normal. It is possible that you are right now analyzing in the recession part. So in that case, there won't be further recession, but there will be only improvement. So, so that is the job of the analyst. So these future scenarios are structured in the form of financial statements. Means these three financial statements: revenue, income, cash flow, and balance sheet. You will have that what will be the value of those statements under different scenarios, and are known as financial statement models. So why are the financial statement models? Because they give all the detailed information. They build the model that, okay, if this situation, this will be the income, this will be the cash flow, and this will be the balance sheet, means, or this will be the value of equity, which is total assets minus total liabilities. So here is the company and industry analysis framework. First one is company analysis, past and present. So present means present quarter, and past 3 quarters, or at most 4 quarters. Normally we don't go too much in the past, but we go for about 9 quarters in the future. That is the Basel III requirement, and also industry practices, because you make prediction for 1 year. Whenever you recommend, suppose the price of equity is 10 right now, $10, and you recommend it to be $12. Your recommendation is valid for 1 year, means because your recommendation is for long term. So if the equity price rises to 12 in 1 year, or even after 3 months also, then you will be considered correct. So that's the past. And present analysis is the recent past, means 3 quarters or so, and then present, so total 4 quarters information. Then there is once company analysis, then what is the industry and competitive analysis? So competitive analysis, that Michael's 5 forces work. So that gives the competitive analysis of this position. And industry analysis tells that what will be the growth of this industry. Not that the GDP will grow at 6%. That doesn't mean that this industry will also grow at 6%. This industry may grow at 0%. This industry may grow at 15%, depending upon what the government is focusing on. So if the government is focusing on this industry, most likely its growth will be much faster than that of other industries, because the government will direct its tax resources to this particular industry. And then that will also include this past and present, how the industry has been growing. Like when there was COVID, the medical industry was growing at the fastest rate. The vaccine industry specifically, not that the entire medical, but yeah, hospitals were growing fastest because many patients should go there. And then this vaccine industry, research and vaccine. And then company analysis, forecasting. So company analysis, then industry analysis, and company analysis and forecasting. So based on those scenarios, so this one was bottom, because we started with company, then we moved to top, and we should have moved to GDP as well, means entire macroeconomic, but here it is talking only about company and industry analysis framework. So GDP level is analyzed by economists. So, and since it is financial professionals only, so they don't go about GDP, and so that's the reason that it stops here. So what does he do in company analysis? Determine business model. analyze revenue and revenue drivers. So what does business model contain? Okay, we will study in detail that what it produces. Then analyze operating profitability, analyze capital investment. All these are micro level analysis. Industry, define industry, which industry it is. It is easy to define. And size, growth, and character, profitability, market share trends. So within industry, what is the positioning of this company? It means analyze the size. Analyze industry structure means whether it is monopoly, monopolistic, perfect competition, and external influences means government policies, how it is affecting the entire industry, and evaluate company's competitive strategy. So those Michael Porter's 5 forces. So where does it stand? What is the power of buyers, power of substitutes, power of potential entrants, power of suppliers, and power of demand means existing consumers. So all these are the 5 things, and then based on that, they will determine the forecast of the 3 financial statements. So that is the first step of preparing the company research report. Now, here, this is if you are on the sell side, means reports on a public issuer's equity security for distribution to external clients. So what do sell side researcher do? I was on the sell side researcher. They prepare the report independently. You don't have any boss because you are on the sell side. You are your own boss, and then you will distribute it to your clients or to your potential investors in that company, and that way, that is your business. On the buy side, the company portfolio manager or the CEO will be your boss definitely. But if you are a sell side researcher, then you are your own boss, and it is you who can attract as many clients as you can by your report. And that consists of extensive initial report. Extensive means it gives much detailed reports, so that you don't know your client base. Some might be good in finance and others might be just ignorant. So that way you will have to give more details so that it covers larger number of clients knowledge. And what about buy side? Buy side, they are working for their own company, so they have more resources, and the portfolio manager is also a knowledgeable person. He knows that what industry is where. So in that case, your report will be much smaller, or the structure will be provided by the portfolio manager. Okay. So first report will be longer, second report will be shorter, which will give only the updates. And it will come after 1 quarter. Normally it comes after 1 quarter, but sometimes if there is a big update, like regime change, in that case, it can come in between also. But normally the updates come after a quarter. Okay, so here is the example of one report, and we will study it in briefly. So initial company research report, front matter. So who is the issuer name, means the name of the company who issues the equity, and security identifier, its QSIP number. Analyst, your recommendation will be buy, hold, or sell. That will be in the front matter, because everybody will like to read first before reading your report that what is the conclusion. So it is on the top page. I think I had prepared an equity report. I don't know if I can get this. Otherwise, I had, when I was equity researcher, I had prepared equity research. So if I am having, then I will show you the actual equity report. Otherwise, I will show you sometime. So let me see. Where can I have that equity report? Somewhere I should be having. Okay. Let me see if it is here. That's COVID. Otherwise, it is on the first page itself. So first, the recommendation is on the.
Sir, was it for that company where they discounted their cash flow instead of actually proving the research results?
No, it was discounted the cash flow. Yes, it was exact.
Some accounting fraud the company did know that
Oh
one.
yeah, that it had done. Yes, I have both the reports here. That also I have, and that was of Vaxart, a small company that it received
It
COVID
received
funds.
money. Yes, sir.
Yeah, but it had not received. Yeah, I have that report also. Yes, and then I don't know in where I have saved that. Okay, it might be. Why do I have this too? Okay, yes. So I might be having, and I will show you that report. I am definitely having somewhere in the email, definitely, but I should have looked it before. But let me see. If it is, where is the equity report? No, maybe the company was singular because I was on the sell side analysis. I was sell side analyst at that time. So, okay. If I don't find, then I will find it later on and share with you the actual report. Okay. So, probably it is not here. Oh, yeah, it is. VXRT report. Yeah, VXRT. This one and Vivo. Yeah, here are the two reports. Vivo equity. Yes. So, this company had done the fraud. And so here, wax starting price as at the close of July 17 was 1575, and then I had recommended you see sell rating. Here is the rating, no? So I had recommended sell because it had, and here all these are red. So, and then 12 months target price, then mine was definitely lower 9.75, Alakh Niranjan Singh CFA, and that was my official email address. So, and official phone number as well. So that's
So,
why,
like this 12-month target price at the end of the 12th month, it should be 9.75.
yes,
That is the ideal price.
that is the ideal price or estimated price. That is
Okay.
what it is. Yeah, intrinsic value.
Intrinsic value.
Yeah, that is the intrinsic value.
Sir, is that the average value or is that the singular intrinsic value?
Single intrinsic value calculating the average of scenarios.
Okay.
Yeah.
So in case like people understood your report and they bought it below 9.75, then will you?
Then also I am correct. If it is
sir,
9.75 or below, because I have already recommended sell, no.
So then you will prepare a new report for making it to be buyed, no? So like because only then it will be 9.75.
Yeah,
Again,
if it is 9.75, yeah, I will, after 1 quarter, I will again have the report. Because this one is this was July 17. So in October, I will again prepare. I had prepared on July 19, 2020. This report was published on July 19, 2020. And so that's why, and I think it was Sunday, that's why I wrote the Friday price of July 17. That was the last available. It was Sunday night, July 19, 20. So otherwise, had it been Monday, then then it would have been 3 days behind. Had it been Tuesday, then it would have been yesterday's price.
Okay, sir.
Yeah. So that's how this report is prepared, and this one is it gives all the information, investment thesis, risks. So you see, the return means the risk is always on the first page. So it is common to all the report. Yeah, it is common to all the report. Risk and my return, and return means whether I am giving buy, sell.
So the first page is like a summary of the entire.
Summary of the entire thing, yes. So here it was 1575 was the price. Had it been 1775, then that was giving the return that okay, this is expected return in 1 year, $2 on investment of 1575. So that is the return, and I would have recommended buy. If it had been only 1650, I would have recommended hold. Not buy, not sold, because expected return was not really very high, 7-8% or 5%. This is not the best thing. So probably I won't recommend buy. I would recommend only hold, because in that case there are other opportunities where the person can earn more than 7-8%. Then why should I?
In hold, if a person is holding the stock, he'll hold it. But if a person is not not having the stock, will he not buy it or will he buy it, sir?
He will not buy. He will simply hold it. Means he will not put additional money.
So whatever he has, he will be having it. But for a new investor, he will not invest into this.
Yeah, he will not invest it. If he's a new investor, then and I am telling hold, means his holding is zero, means his holding is zero.
Sir, then could he do short selling?
Short selling also he may lose because what if the price doesn't fall? Then
But if it's a sell rating, you will definitely do short sell or
yeah, he will definitely do sell, sir. Yeah, if I do the sell rating, then he will definitely do sell.
okay.
So in hold, you are indifferent means in the sense that you are not making much money, but you are not losing also. So you are saving your transaction cost.
Okay.
So if you are saving your transaction cost, then your return, holding return will be higher, like passive investment.
Okay, sir. Okay.
Yeah.
Yes, sir.
Oh, yes. So that is the true or false report. And then let's go down. So you have to show those two things prominently on the first page itself, because many people look at that only and they might not understand many jargon, like okay, so let's see how I reached this conclusion. Then in the end I have this financial statement. I gave investment thesis, that what is their thesis. Then if you want to read it, I will send you, I will email
Yes,
you.
sir. Please send it after the class.
Okay, yeah. And you see, I had built this, and then you will become an equity researcher, a real equity researcher. Valuation, and here is this return on capital versus discount rate, forward PE ratio, and forward EPS. And then where are those? Yeah, here are the financial statement. Quarterly, annual. This one is income statement, and for how many quarter? Quarter 1, 2, 3, 4, 9 quarters. You see, this one is the current one, and then I have projected for next 9 quarters, and this one is annual. So that's why I highlighted it. That it is their fiscal annual report. Both these highlighted are annual reports. So 2 years, 1 month report, or it can be 2 years report, depending if this is the annual report. And then after income statement, this one is cash flow statement, quarterly and annual balance. Oh, this one is balance sheet, sorry. Income statement, then balance sheet. And then below that, it will be cash flow statement. Yeah, here is the cash flow statement here, you see. And then in the end, it is the calculation of WACC.
Sir, whatever you have highlighted in red means it's a loss.
It is loss, yes. It is loss, yes. Or it is negative. That firm value is minus 1820.
So those are negative indicators.
Those are negative indicators. Yeah, red ones are negative indicators. That's why I recommended.
So like if people just go through the glance of the reds also, they can see lots of reds and.
Yes, and then they can say that okay, sell it.
Okay.
Okay, so this is the true annual report.
Sir, but if 10 people are recommending buy, 10 people are recommending sell, then is it advisable to hold it, sir?
It depends upon the analyst skills. No, that are analyst equally skilled. Whose report? You get the rating of analyst as well. That what are his recommendations, percentage of correct recommendations.
So then most likely the skilled analyst will come to the same conclusion.
Skilled analyst will come, means all skilled analysts will
come to
the same conclusion. What happens that many equity researchers don't know economics, and especially macroeconomics. So there they fail at the top down. They will at the bottom up, and some of the analysts are not able to catch the mistake, because I was the only one who had given sell recommendation, and there were 15 other analysts who just read the newspaper report that they read the news report that yes, Wax Art has applied for funding. Okay, COVID funding has been accepted for consideration of funding. That was the report. And looks like that report was paid by Wax Art itself. But Wax Art proposal has been accepted for funding by this US Department of, what was that? Okay, US Department, okay.
Well, now, FDA, sir.
The FDA, yes. Yes, has been accepted for funding by FDA. That was the kind of report. Then I realized, okay, if it has been accepted for funding, shortlisted for funding means it will be funded. And then the proposal amount was some 60 million or 100, something like that. It was big money for research and development. So I said, okay, it has been accepted, so the news should be. Then I looked at their financial statement that, okay, in the cash flow statement, has it been written that on this date, any funding has it come in the cash flow statement, and it was not there. So I took it longer. I looked for other, okay, is it in income statement? Is it in balance sheet somewhere? And nowhere I could find that 60 million job.
So you looked at the balance sheet for how many years, sir? Like 2-3 years?
No, I looked at the balance sheet for that quarter especially. Previous I had.
Oh, okay,
I had
okay.
built for previous 3 quarters.
Okay, sir.
As a
So here you have mentioned 2019 A, E, and E, sir. What is E, sir?
estimated.
Oh, okay. So 2019 actual. Okay.
Yeah, actual and estimated. So I had, so then I didn't find that actually money anywhere. Then I said that, well, this is only report. The money has not been received. And I couldn't verify from the news reports that the Vaxa didn't get the money. That was not there. So I said that no, it has not received. Otherwise, it would have shown somewhere in the cash flow statement, balance sheet, income statement. Means in balance sheet also assets should go up, and it wasn't there. So then
Sir, but that's a very basic thing, no? So like many people, if they overlook it, then their rating should be down.
If they overlook, no, but then they say that, okay, this newspaper guy must have verified it.
Sir. That is a very convenient thing to say, sir.
Huh?
That is a very convenient thing to say.
Yeah, that is very convenient thing to say. And many equity analysts do that. Because all are not CFA also. Most of them are MBA finance and those also chartered accountants. So these guys don't know much about the problems. Chartered accountants are supposed to know, but then still they themselves do the frauds. So chartered accountant is paid for misleading the accounts. Otherwise, if he gives correct information, nobody will hire him. Why will anybody pay to a chartered accountant when he doesn't save them money? So the chartered accountants actually they promote fraud if they want to get more money, and that fraud would be such that normal people are not able to catch, especially the government babus. They are not able to catch, and well, only good equity analyst can catch that, or bond analyst. These two people can catch the fraud of chartered accountant. Otherwise, why will they be paid money? Okay. Then these big four companies, even they had given AAA rating to many firms, and then which became bankrupt in just 2-3 months. And even Anil Ambani's funds were audited by Big Four, and he had committed fraud. So Adani, fortunately, they didn't do for Adani because the law had changed. After Anil Ambani's fiasco, the law was changed that they should be made responsible. And this, what was that? The big famous PwC, I think it was PricewaterhouseCoopers. They had to pay fines to Indian SEBI, and then matter was settled. So they didn't get any punishment. They simply did out of court settlement, and so the law was not changed. So that's how they do. So, and if it is a small accounting firm, they will overlook it. Now, many equity analysts will do that, okay, the chartered accountant has passed, means it is correct. So they don't take the pains of verifying. And I was actually late by others, late by 3 days from others, or rather 2 days. When I saw that, well, others have published by 15, I was really worried that I couldn't prepare the report. And I didn't find the cash either. And all these are saying buy. Then eventually I recommended sell. And so then many people read it and then said, how are you saying, how can you be so wrong? So then they kept on holding. But then when it fell, then they called me and said that, oh, you had given the correct information. But they like Wax Art Price, let me see if there is, I think that company is closed now. Wax Art Inc. Is it, or Wax Art Inc.?
Then your report closed on companies.
Yeah, 59 cents. The price is 59 cents now. So I had recommended 9.75 when. in July 2021. That should be the price. That was my recommendation, and now it is 59 cents. So let's
So,
say maybe
would,
5 years.
like when it is listed in the US stock markets, what is the
It
minimum
was.
price?
Huh?
What is the minimum price? Like,
Minimum price, it was a small company. It was listed at just, you see, 2019, its price was 31 cents. And here it is July 24. Oh, yeah, here was the max price. Let's see.
okay,
1570.
when you prepared the report, it was maximum price.
Yeah, 1575.
Okay.
And then I had recommended in when is 1 year, no. So this
Yes.
one, yeah, so the 1575, you see, it is in the verifiable on internet, what I had recommended. And then on October 9, 2021, March, so October 22, it is 1 year, July 30, 17, 719, means lower than what I had recommended. I had recommended on July 1st, so it was 875, July 30, and then July 16, yeah. So it is 814 on July 23. So that should be the price, July 23, yeah, 814. I had recommended 9.75. I was very close, and then correct as well. So that way you can see that what my rationale. I will email you, and but still the U.S. government. So that's how it happens. That many equity analysts are not able to predict correctly. They don't know whether this accounting fraud has been done by the CEO or not, and it was done by the CEO. Clearly, it was done by the CEO. So let me see what I had recommended for sell. Had I recommended in this investment thesis, better business advancement in, okay, where I manufacturing, yeah, here it is. Investment risks. It is important to note. So I have highlighted into red. Okay, now conclusion. So let's see what I had written in the conclusion. The conclusion is Vaxart stock prices skyrocketed with the recommendation of B. Riley, probably with the hope that the animal study under OWS would deliver favorable results. We are keeping a close eye on the company's press release in August for updates on the study's progression. Means company was releasing in August. If the animal study doesn't conclude, its oral vaccine platform makes it an appealing collaboration for other vaccine developers, and it has a handful of other vaccines in the pipeline for future growth. Our bottom line conclusion is that it is too early for most investors to buy Vaxart stock relying solely on COVID-19 vaccine success. There is still a lot that can go wrong. We think Vaxart vaccines are worthy of being on investors' radar screens. It is just too risky right now to call it a great pick to buy because Vaxart is not the leading researcher on COVID-19 vaccines, but their oral vaccine technology represents an important advance in vaccine technology. It was because of that oral vaccine that none was doing oral vaccine or injecting, and so that's why Vaxart price had gone up that much. So the technology is designed to generate mucosal, systematic, and durable responses. If we go beyond COVID-19 and see the probability of success of its remaining six vaccines, all these are six vaccines, in addition to COVID-19, the risk becomes diversified and small, but windfall gains also become small. If any one of the vaccines succeeds, Vaxart is going to have positive revenue from its first quarter of 2021. Additionally, the oral technology platform can be used for additional new vaccines even beyond the first quarter of 21. So based on these possibilities, we expect Vaxart revenue will increase by 9.2% during fiscal year 2020 and 21. However, they are far less than expectation than has recently given the meteoric jump in the stock price by over 3,000%. So we are confident the price will fall. So that's what I wrote. And we are confident the price will fall. And then valuation. So what is the conclusion in valuation? We see that has no chance of winning the race. Okay. With the latest news update on 18th July 2020, we see that Vaxart has no chance of winning the race. At least 5 competitors are running significantly ahead of it. Then there are foreign countries like Russia, UK, China, and even India, which are claiming that they have made significant progress in finding for COVID-19. Russia has been using the drug Avifavir in its hospital to cure corona patients. When competition is so intense, and giants like Pfizer, Oxford University, Imperial College are competing, we don't see any of them falling behind Vaxart. Further, Russians, Chinese, and the rest of the world would be using their own homemade vaccines or drug to fight corona. Hence, we don't see a good chance of Vaxart to enter into international market. With these facts, we recommend sell for Vaxart. Its price falls significantly. Here I had written, he will be wrong again. Then the question arises, why did this year price of Vaxart jump around 3200% last week? Our analysis says that it was based on exaggerated expectation of the market from Vaxart. The market had expected that Vaxart was the leader in disruptive technology of oral vaccine because they were the first company to produce oral vaccine, and the company would win the COVID-19 vaccine race. Prices doubled on Monday, July 13th, after B. Riley FBR published its favorable report about Vaxart. We noticed that their equity analyst, Mr. Mayank Mamtani, had prepared this favorable report. His 93 out of 199 rating have been successful. Thus, he has been 53% of the times wrong. And we believe he is going to be wrong again. So that was my writing. I wrote B because the CEO of this cell firm, I needed to include him as I had to write it as a team. So that's why I used we. Otherwise, it was 100% my contribution. So that he has been, and the CEO didn't publish this report. Surprisingly, he didn't publish the report. He says that you are being too aggressive.
Instead of saying the truth is being aggressive, then what?
It means that
if saying the truth is
yeah.
aggressive, then
yes.
how do you report
my language is a bit strong, no? My
that?
language
Yes, sir.
quite confident.
Yeah, but it's confident, sir.
Very confident language.
Yes, sir.
So this is what I get. Okay. So I will send you this email. I will send you the other report as well. That also came out to be correct. So I had prepared that report. After he didn't publish, I got angry with him. And I said, I will not work for you. And I left the job. I said that I will not work for you. You don't respect my talent. Okay. So that's how equity analysis can be very accurate, you see. At least how accurate I was. Now, so that is the front matter. It must contain two things: expected return, and your recommendation, and then risks. Oh yeah, here is the recommendation, analyst recommendation. Company description, yes, I had written in short part. Then industry overview and competing positioning will be after that on the second page. Then on the last, it will be financial analysis and model, means those prediction of 9 quarters. And then valuation. So I had included in the end that what was the WACC, and then according to that WACC, what was the value. Now this ESG has been added again. And this risk is detailed risk, evaluation of material downside and upside risk, that I had written in conclusion. So, so that was the structure of any equity research, and especially if it is the first research, then this should be that should include those things. So subsequent.
The first and subsequent means what, sir? Like
subsequent means next report.
For example, your company has released a report on HUL, but your company has published a report on HUL stock,
Yes.
But at that time you are not employed in the company. But right
Yes.
now, like after you are employed, you are publishing a report for HUL. Will that be called as subsequent report or first report?
That will be called subsequent report. Means what? My first report was published and they received it. So
Oh,
after that, even if I left the company, then I can publish only the updated one.
okay.
Yeah.
So,
So that
will it have the link to the previous report also?
I can, since I am the owner of that report, so I can always give that this was my previous report. Because
Okay.
I'm having one copy, no?
Okay.
Like I have the copy of Vaxart.
Okay.
Means if you are equity researcher, then you will have you are actually the intellectual property owner of that property.
Okay.
It is your intellectual property, so you will always have the copy.
Okay.
But you are not allowed to share immediately, so long as it is valid period. Means I wasn't allowed to share for at least July 30th to anybody else. Means there is
Yes.
a period of cooling period, sorry, quiet period. So during the quiet period, I cannot discuss with anybody, even my family member, and I cannot share it with anybody because that is the property of the company. Otherwise, it will be insider trading. Means if I share someone else,
Yes, sir.
then it will be insider trading. Uh, okay. So that was the structure. Now, subsequent company research report, what it will contain. Front matter will analyst name, issuer name, and risk will always be there. Analyst recommendation. So this one is means the return part, and then the risk part is also there. So these two will always be there in every report: return and risk part, and based on these two, analyst recommendation. So analyst recommendation is the summary of risk and return characteristics. So analysis of new information, yeah, here since it is subsequent, so there has to be new information, and based on the new information, what will be the value? Valuation is to company and security value. So that is so subsequent report is much smaller. Okay. So now the question for you. Okay, read this question.
Yes. Which of the following statements about initiation reports are true? The structure, the content, and tone of the report are independent of the analyst setting. Report makes updates to the recommendation after the issuer reports financial results. Primary audience is those who are not already knowledgeable about the ratio of the security. Sir, is it? Maybe C, sir, because it's primary audience who do not know it already.
They don't know it, so you have to give them detailed information. Very good.
So this Vaxart report you prepared was for
Primary.
primary.
That was my primary report.
Okay.
Yes.
If you read a research report that includes both Porter's 5 forces analysis and a pestle analysis, then most likely the authoring analyst is initiating coverage. The report is updating a recommendation after earnings release. Report is written by firms analyst was covered the company for many years. No, sir. No, do it only initiate coverage.
So A1. A.
A.
Yes.
The evaluation of a company's strategy takes place before
Competitive strategy. Yeah. The evaluation of the company takes place before the
analysis of revenue and revenue drivers, analysis of operating profitability and working capital, forecast.
Yes, that's what correct. Yeah. Okay. So determining the business model. So how do we determine the business model? Means there are 4 or 5 questions that determine the business model of the company. Means what the company is producing, what are the other products, means how many products is producing, what will it is not single, but it can be multiple products, no, multiple lines of business. Like even for banks, like they are accepting the deposit, giving loan. So giving loan is their one product. Then they are also selling many services, like insurance services also they sell that, okay. Then they also sell time deposit products, not only loan, but they sell time deposit products as well, or what do? They do a lot of things. Bank draft, they provide money transfer services, provide, or sending money from one country to another, foreign exchange services also they provide. So you take draft from them. So all these are the lines of business. So determining the business model, what questions do we ask? Means what the firm is selling is the first question, means the product or services of the company. Then who are the customers and key customers group? To whom does the company sell? Now, what happens? To whom? One person or millions? Then, or a few persons or millions? So that will give the customers and key customer groups, means like even though the company is selling, what I would say, which word should I use? Okay, toothpaste. Okay, but the Walmart is the buyer, or here who is the, okay, yeah, let's have this. What does Reliance sell? Nita Ambani, sorry, what is his daughter's name? Isha Ambani. She sells luxury apparel, no? Then she will be the only buyer or one of the biggest buyers from large number of sellers, producers of apparel. So that way, even though the customers are in millions, but in this case, the key person will be only Isha Ambani. So that kind of things we have to see, that if it is a retail store, then that becomes only one buyer for millions of buyers and buyers. So to whom does the company sell? That is the second thing about business model. What is the firm selling? To whom it is selling? And sales channel, how does the company reach potential and current customers, and how does it deliver products? So how does is it delivering online? Is it delivering by opening retail stores? There, in that case, the capital investment will be very high, because it will have to either rent retail stores or build retail stores. And then, and if it is on online, then it doesn't need to build anything. It will simply contact the manufacturer and sell it, ship it to the end user and earn the commission. So if it is networking, then how does the company charge and how are prices and payment terms structured? So again, this becomes the whether it is a monopoly or perfect competition. If it is perfect competition, the price will be equal to marginal cost. If it is monopoly, then there is some degree of control. Means monopoly has 100% control over the pricing, but then he has no control over quantity, or he has 100% control over quantity but no control over prices. So that way, how much does the company charge and how are prices and payment terms structured? Then payment terms also means there can be negative working capital. Like who had, I think Apple had negative working capital, yes. Means the supplier supplied it for long period, for 3 months, and from the buyers, they had to pay by credit card immediately or debit card immediately. So payment term structure, so that gives competitive advantage. And what does the company buy and rely on? Means here is the power of suppliers, supplier partner relationships. And then so it is possible that suppliers might be financing as they finance to Apple. So basically, 5 forces of Michael Porter, and then that is what is this analysis. So that tells us about the business model. The business model elements, key questions for analyst. So how many questions are there? 1, 2, and then we have 3, 4, 5, only 5. So basically, these are the 5 forces. Only thing was what Michael Porter had not told about these payment terms, that there can be negative working capital. So the bank doesn't, means the company doesn't need even to borrow money. Otherwise, rest of the things are part of Michael Porter's 5 forces about the business model of the company. Then issuer sources available freely if the company is public. Then public third party sources, film industry with papers and analysis report. What does this tell? This one is about information. So how to get the information about those five sources? So one is that in the issuer sources, that the issuer gives in financial statements, and on its website there will be written that I am so and so, I was founded, I have my history, all those. So the how does the analyst gather information? So first source is the issuer himself. Website, you can even visit his office if you want, or no, otherwise company website. Then all those press releases, presentations, and given to investors like financial statements. Then public third party sources means industry white paper, government with itself is a third party source that gives the information, public third party sources, and proprietary third party sources. So these people are like Bloomberg. They have the information, but they are private because it is their analysts who do that information, who prepare the information as per your need or as per their need, which they can sell. Obviously, they will give their own comments also. So proprietary third party sources and proprietary primary research. So primary research is normally done by you, but your friends can also do. Or if you are on the buy side analysis, you are a buy side analyst, then your company will also do proprietary primary research. Then you can do surveys, conversations, product comparison, and other studies commissioned by the analyst or conducted directly. So if you are an analyst, you can do that if you have time and money, or you need that information, you can do that. So those who are in the investment setting, they have this proprietary primary research access. So now let's go to the case study. And this one is the case study of a company, Warehouse Club Inc. And then who is the analyst? This Elaine Nguyen, I think Vietnamese. Elaine Nguyen is an analyst from Piloton. To find investment candidate for one of Piloton's funds, Nguyen ran a screen of companies in developed market that exceeded a certain level of sales growth and return on investment. Okay, so what did he do? Of the last 5 years he did, because he's preparing the first report. It is not that he will give the financial statement of 5 years. He is preparing the report, then he wants to see how the company grow during the last 5 years. That I have also done. Okay, so this one is all about the determination. Now let's see what it has. It is giving the details that what he found. Let's see what does he do. Okay, where a number of stores at the end. He said that 108 stores to 149, and that's how they grew in 10 years. Then we go down. Number of members at the year end means it is selling its product is club. Okay, so product is club member and one is a stores. So it has 2 products. Third product is annual. This one is annual net sales. So it has selling through stores as well as through club membership. Means they take the membership fee and then they can buy it at a discount. So they will pay them. So that becomes a source of revenue. Okay, annual net sales, and these are the financial statement. So let's see what the analysis, because these things, you know, in the accounting we studied financial statement, and we are made the following statement that we are not in annual report. So okay, let me see if this is useful. Otherwise, because I wanted to prepare the structure of the report now. Yeah. So first step, determining Warehouse Clubbing's business model. So all that information has been gathered. Now, after gathering that information, what is the firm selling? That is the first question. To find the business model of the club warehouse, means of the company's business model, what the firm is selling, and warehouse sells a large number of consumer goods, mostly consumables and perishables. with perishables, means like vegetables and meat, etc. Approximately 4,000 unique items. Okay, that it sells through stores, and for customers to shop at these stores, they must hold a membership, which warehouse sells for $60 per year. So it is receiving revenue from two sources. First is through membership, $60 per year, and another is the prices that they pay at a store. So there will be some profit there also per household. So Newen graph the following net sales category. Okay, so this is the graph and the comparison. Okay, we already saw the graph. I think is there any graph? Oh, here is the graph. So non-food merchandise includes a broad range of items such as appliances. So he made this pie chart. Percentage of food and beverages 40%, fresh food 13%, and then okay, that was packaged food, and this one is fresh food. Non-food merchandise 28% and ancillary other 19%, and he said 4,000 items anyway. So that is what he had prepared. So in the first business model, he prepared what is the product of the company. Yes. So what is the firm selling? And the next step is to whom? The customers. So it has members. And so it is not selling to one large retailer. This company itself is a retailer. So it will buy cheaply because it has this power of buyers. Are primary consumers that live within 10 kilometers of a store. Okay. So it is servicing as per the geographic location. So to whom? And then how it is selling products. One is through a store and it is selling through online. The answer is probably no. Warehouse sells products and services both in and around its stores. So members can either shop at the store or shop online and pick up at the store. Okay, so they don't have to wait in the queue. They can simply order and then their employees will deliver the goods. They will place at one place and then they can collect it and pick up at the store. Okay. So that is the another way that how it is delivering the product. That is the business model. Then for how much? So how much means the price revenue. So warehouse has two revenue streams: goods and services, for which it earns net sales and membership fee. So membership fee is $60. This one is very much predictable, and net sales it has been given. Then the cost of goods sold, then gross margin percent. All these are calculated. So this you will have to give in your primary report. All this you will have to give. So you can always, if you get an equity research, you can have this chapter before you. And if the company has not given you any template of its own, you can use this template. So that determines the business model. What it is selling, for whom it is selling, who are the customers, then what is the delivery mechanism, and what is the pricing mechanism. So it is charging actually two level of prices. One is membership fee and the another is sales. Sales commission, whatever they get means price minus cost of goods sold is the margin. Question set, how did this come? Eliso Marketplace, this is another company. Based on the information provided, what would you say? This one was about that warehouse company. And now this one is another company. But the question set came before. Eliso Marketplace Limited is a redefining e-commerce by delivering superior customer experiences. So how can the question set come before? Okay, anyway, let's see. Let's go down. Some problem with this book. We are committed to delighting our customers every day. Hallmark. Okay, so this gives their strategy, business model, that they deliver faster and next day, then free shipping if they purchase greater than $25. A vast selection of items means they have so many items listed on the internet on their website that they can do, like Amazon you have done. here in India. Then frictionless returns. Okay, if something is not found, it will be returned. That is their business model. The number of active customers account was uh, 36 million in 2019. Okay, and 2019 it was 36 million. It increased. Now our fulfillment network. So how do they do that? It is about their business model. So this is just another example. So let's go down. Why to waste time? Then it also produced its our annual gross merchandise value. So this one is the detailed value of how do they sell it, which includes the value of all products sold on our marketplace by us and third party merchant. Means since this is an online business company, so it has third parties also who come to its floor, like Baba Ramdev had joined Amazon, so he could sell his products using Amazon website. All products sold on our mark. So one is Amazon directly selling, so that it is selling directly, and then another is the third party merchants. So this gives their revenue. Now let's go down, and here is the marketplace. So Elisa marketplace GMV customer and merchant counts for the year. So this one is their comparative third part. Okay, so this one is one segment, retail sale. Another is merchant sale. Obviously, it is much smaller because here the cost of goods sold is part of the merchant cost. But in retail sales, it will include cost of goods sold also. So that's how it is getting. Now, active customers, we had 36 million in 2019. Third party merchant, they are also growing actually. So third party merchants are 40,000. They increased from 14,000 to 40,000. Okay, pretty fast. And customer base also increased 2.5 times, and this increased about 3 times. So this one is giving the income statement. Now, what does it want to tell? The notes to provide the following net retail sales. Retail sales are earned from the company's online product. Okay, so these are the notes. So let's go down and see what is the question. What do we need to learn? What form of customer base for Elayo Merchant Services segment? Elayo Merchant Services segment. Okay, so let's see if where is the merchant services segment. Cost of the third party. Here is the third party merchant fees. So this is the third party merchant fees revenue includes commission and service fees earned from merchants that sell their products through the company's online business. This revenue is recognized when the order is completed and transmitted to the third party merchant. So is the revenue recognized? This revenue is recognized, okay, but oh, this is a merchant fee. So it is earning through merchant fee. Okay, is there any other? The cost of revenue primarily comprised. Okay, let's see what is the question. But I want to see if there is any other information about third-party merchant segment somewhere else also. No, this one doesn't. Marketplace limited. This is about GMV. Means gross merchandise value segment. So it is not merchant part. Anything before also? Merchant services, here it is, yeah. So in 2013, we launched merchant services, allowing third-party merchants to sell products on Eliso marketplace and utilize our fulfillment network. So they are using the network of Eliso. And when multiple merchants sell the same product, our algorithm says the customer the lowest price, including shipping cost, though the customer can manually choose a different seller. Third-party merchants must meet our rigorous quality standards, but otherwise have discretion in product assortment and description, pricing, and shipping terms. So they have that discretion in description, pricing, and shipping terms. We receive sales commission on third-party merchant sales as well as service revenue. If merchant utilizes our fulfilled network for warehousing and delivery. And we record revenue on net basis. So let's see what is the question now. I think we can answer the question on this basis. So the question is, what forms the customer base for merchant service? Oh, so only it was easy question actually. Third party merchants are the customer base. He doesn't have to worry about its customers. E-commerce customers and fast food and no, only third party merchants, they are doing everything. They are selling their product and it is charging commission from them. So for this company, merchant, third party merchants are the customer because the source of revenue is the fees from third party merchant and what else? Service charges, no? These two were the earnings. So they are basically service revenue and this fees, commission, sales commission and service revenue. So they are the customers of this merchant. Third party merchants are its customers basically because whoever is the source of revenue is your customer. Okay. That should be the answer. Let's see what is the answer. Third party. Yeah, A is correct. Merchant services. Now, what is the next question? Okay, you read question number 2.
Yes, sir. Eliso's business model is likely to benefit from dash effects, network, value chain, supply chain.
So, which one is the one in the model?
Sir, so like if more people use it, then it's beneficial. So it's like network.
Very good. Network. All the third party merchants will also.
Yes, sir.
Yes, that is network. They are using the network.
Which of the following business features is least likely to increase consumer retention or stickiness in the platform? Focus on urban markets, next day or faster delivery. No membership fee is required.
So the question is least likely, means which is not helping. Yeah.
A faster delivery would help them. Membership fee, so that would.
That
There is
will
no.
increase. Yeah, it will increase. So it is not least likely, it is most likely. If it doesn't charge membership,
Oh, okay,
then
okay,
more
okay.
members will come.
More
It is
members. Sir, then A.
yeah, I focus on urban market. It is least likely. Yes, A is the correct answer. Okay, question 4.
The gross margin of Eliso's merchant services segment is most likely dash than the gross margin of Eliso's retail sales segment.
Gross margin means this gross profit divided by sales.
Yes, sir.
So which one should be higher? Just general knowledge because it's not given in the information.
Oh, okay, sir. So merchant services should be highest now, sir. Like
Very good because there is no cost involved.
no cost.
Yeah, it is taking only commission. So no cost of storing goods, no cost of selling goods, no SG. SG is a small part. So that way it will have high STS. Is correct. Okay. So revenue analysis. So first part was business model. Then second part is revenue analysis, means income statement. And then what are the revenue drivers? So revenue drivers means, driver means which factors, what are the regions of revenue. And driver means the region of revenue. So what in other words, the analysis involves identifying what are the drivers. After we turn to the okay, what does it want to tell in? Okay, though I know it is the region. Drivers are the regions for revenue. The analysis advises identifying drivers, which are here. The drivers are causative factors that explain the level of and changes in output variable here, revenue. So all the drivers are the regions or causes, the factors that explain why it is happening, why it is changing, and understanding the evolution of the driver over time means how do the regions of revenue change over time. So in this case, there are two approaches, bottom up and top down. The best thing is take both the approaches independently, not that you are taking jointly. Take both the approaches independently and try to match, whether they match or not. And most of the time, they will not match. So if they will not match, then give the average value of the two. That from bottom up, the price comes out to the revenue comes out to be what 1 million, and from top down it comes out to be how much 1.2 million. So give your best estimate as 1.1 million expected revenue. So that's how you will do that. So how does the bottom up approach means? We start with the company, then go to industry, and then go to the GDP level. In top down, we will start at GDP level, then go industry, and then go to the company level.
So this
By-
was the same thing we had seen in financial statement analysis.
Yes, exactly the same thing. Nothing new. A lot of finance is being repeated here
Okay. Sir.
because you are equity researcher. So okay, let's go to the next part then. It is the same thing, or revenue analysis. So here it is exactly the same thing. So let's go down then. Okay, is there any? Yeah, now pricing power. How will you do? The same Michael Porter's 5 forces, the pricing power. So depend. That tells us this. Here, one new thing is there, and that new thing is this. How will you look at the financial statement and know whether the company is in monopoly or?
Yes, sir. I was about to ask that question.
Oh, very good.
Yes,
Yes.
sir.
Okay. You look at the gross profit margin. If the gross profit margin is quite high, like what should be the gross profit margin? 6% to 7 or 8%. That should be, sorry, that is the net profit margin. And that is the net profit margin. They make only 6. Gross profit margin, 25 to 30%. That means after cost of goods sold, that covers your salary and your other costs, SGA. So gross profit margin, if it is 25 and 30%, means you are in perfect competition. If it is 50%, probably oligopoly. And if it is 100%, or maybe 70, 75%, and over a long period of time, not in one quarter, but over 3-4 quarters, then it is a monopoly. So
Okay.
higher the gross profit margin, the higher is the chance of concentration of industry. So that way, even though you have no idea about other competitors, but if you look at the gross profit margin over at least 3 quarters, and it is consistent, then you can figure out.
So the gross profit margins for like ultra luxury goods like gold, diamond, everything would be like 80 to 100% also. So then, but everybody sells it that way, so that makes it perfect competition, right?
No, it is not product competition, it is oligopoly. Means they have, no, it is still monopoly in the sense that if it is 80 to 100%, well,
Every
it is-
like let's say
okay,
if we
means
take
that may be their value addition. Okay, gross profit margin means the skill addition. Means does it include after employee wages? Because
yes, sir. So like in Surat we have the diamond city now, sir. So every
yes.
like every company over there sells diamonds at the at a profit margin of 80 to 100%. So
Yeah, then they are
they-
monopoly. Then they are monopoly. I'll tell you why. They are hidden cartel, like OPEC. All over the world, the oil is sold at the same price, and those 20 OPEC countries decide the price. So whenever there is cartel, means it is monopoly.
oh,
So if in the Surat, whether
so
they
would
have
that not be oligopoly, sir?
Hmm?
Would that not be oligopoly like cartel?
oligopoly means 3-4 like this Reliance Jio competes with Airtel and Vodafone. So this one is oligopoly. And even though the prices are the same for both, but this one here is clearly distinguishable. But they are all the diamond producers. There are many. but they charge the same price. Means they have internal arrangement that we will charge this price, though it is not open, but it is more hidden. Hidden monopoly means hidden cartel. It is they are charging like monopoly, and it is hidden cartel. Hidden cartel. So that way you can say in oligopoly they are competing with one another. We have the reaction curve, but
Yes, sir.
yeah, so that way that should be cartel, and if it is a cartel, whether hidden not open, then it is monopoly.
Okay, sir.
Yeah. So pricing power you can determine that way. Okay, amongst
So then also we have that formula now, so like 1 minus elasticity by elasticity to determine.
yeah, that one, yes, P times 1 minus means average revenue times the 1 minus 1 by E is equal to marginal revenue. That is what you are saying?
Yes,
Yeah,
sir.
yes. So, yeah, that elasticity formula also will give you. So, but then you need to have the information on elasticity. But that will not be given in financial statement. So I said about the rough way of measuring the market power of a seller or of the company, that what is the gross profit margin, and that will give you the market power. Now, even in perfect competition, well, there is a low cost producer, not in perfect competition, because then all other companies will close if it is perfect competition. So a low cost producer can, however, earn long-term returns above its cost of capital in a highly competitive industry. Which highly? Not perfect, monopolistic competitive industry. Monopolistic competition is highly competitive, but it requires the low cost position to be sustained. So that's what it is. It is giving example. A prominent example is state-owned oil producers that benefit from monopoly ownership of low-cost oil reserves in certain countries. So, like it is talking about OPEC countries, that they have this low cost of producing oil because they have a lot of reserves, and so they are sustaining profit over a long period of time. It is the same discussion that we discussed in one new concept is commoditization. So what is commoditization? So initially a new product is made, and that new product is not very cheap to produce. So highly competitive markets often don't start as highly competitive, but rather become more competitive as new firms enter. And these new firms enter will copy it. So the pace of innovation slows and the imitation becomes widespread. That is a process known as commoditization. Means no research and development because others are competing, are copying you. So when others can copy easily and it becomes widespread, means many firms have started producing, then the lowest cost producer will win. And that process is known as commoditization. Mm, over time, but also by comparing firms' price to its operating profit margin. So that I already told. This part I already told that if they have higher profit margin. Therefore, conclusion, an important signs, an important sign of pricing power is rising profitability over time. Okay, so if the profits are rising over time, I said at least 3 quarters, or if it is increasing, then the firm is monopolist, which demonstrate both an ability to retain economies for investors. Means as the company becomes bigger, the company achieves economies of scale, and that competitors, new entrants, or substitutes are not driving down prices faster than costs. So prices, even if it is falling, the cost is also falling. Why is cost falling? Because of economies of scale. So there are two ways of enjoying economies of scale. One is two factors, I would say. that the average fixed cost declines. As the company produces more, we have studied in economics that average fixed cost is a rectangular hyperbola and it keeps on falling as the product increases, number of products increases. Then second thing means when the company becomes a big buyer, it will ask its supplier to sell goods at a discount, to supply goods at discount, or if they are not giving discount, then it will not pay them on time. It will tell them, okay, our policy says that we will pay after 2 months. Earlier, when they had no name and they were buying in small quantities, then they might have been, the suppliers might would have asked quick cash payment. But when they know that this company is big and I don't have any other buyer here, then they will give on credit. So these are pecuniary gains from increasing size, and decrease of average cost is technical gain from or economies of scale. So technical economies of scale and pecuniary economies of scale, these two drive down the cost. But what will competitors do? They will drive down the price. So what? The cost has fallen more, still my profit is increasing. So in that case, that is a kind of monopoly power or is the market leader. Okay, so this is another example of Nestle SA is a global packaged food. Okay, let's see what does it, the distinctiveness of its product. So that is what it produces. And then it will study the same thing. So top-down revenue analysis. Okay, so the government agency reports total, what does it tell? Top-down from national level to industry level, or well, at the world level also, if it is a multinational company. So analyst can also take a top-down approach. The approach will be discussed in next mode. Okay. Nothing here actually, not really much. That way, so it is telling that first it is taking market share. So top down it will be total market, industry. What is industry output? And then, well, national output, then industry output. So national output is actually the same as industry output for that industry, but national output is GDP. That is the summary of all industries output and all sectors output, I would say, like services sector and agriculture sector also, and external sector also, that includes. So that is GDP. And that is actually, if GDP is growing, and since correlation between industries is not one, so there is some diversification benefit. So if GDP is growing, it is expected that all industries will grow. Some will grow faster, some will grow slower, depending upon the beta with respect to GDP, beta of the industry with respect to the GDP. Though this is the term that books have not written about beta of industry, I just said using the term, the meaning of beta means covariance of this industry with the variance of GDP. So that is the definition of beta. Or in the regression, you make many betas. Beta 1, beta 0 is the intercept, and beta 1, beta 2 whenever you build your model. So it is the same beta. So I am using that industry beta as the beta of industry with respect to GDP, variance of GDP. Okay, so that will give us that, okay, beta is more than 1, then if GDP is growing by 5%, our industry will grow by more than 5%, depending upon how much more it is. So that starts the top analysis. So from GDP, then we come to industry, and then from industry, we will go to the company. So what is its market share in the industry, and if it is growing faster. So same what we studied in financial. Okay, so there is nothing new here. Next 3 observations. Okay, let's see if there is any question. Question set refers to the earlier vignette on, it is Eliso Marketplace Limited that we studied, which had 2 kinds, its own stores and then there were third party sellers. So let's see what is the question. Hmm, what was
2019, the percentage of GMV that Eliso collected from third party merchants was closest to.
the percentage that you collected from third party merchant? Well, you can tell the formula, and that's what you will do. So we don't even have to go and look at that. So the percentage of GMV that you collected from the third party. So the revenue collected from third party and then divided by the total GMU. That will be the formula. And if you know that, then that's it. It is nothing new here. So let's see what it has done. The e-commerce, what did it do? Yes, it took that the merchant fees were 190 million against third party gross merchandise value. So that was the total value. So 190 by 1269. So it is nothing to learn. Pricing power, yes. Question number 2. Read it.
Sir, pricing power, sir, would it be the same rate, take rate?
Yeah, take rate. So how much extra it is charging? That is the take rate. Yes, very good. That is the pricing power. Again, it is calculation. What is national retail sales and assuming monthly retail food. Okay, market share of retail. Leave it. It is just simple arithmetic. Oh, sorry. Let me see what is it conceptual question. Which of the okay, yeah. Please read question number 4.
So the following is an appropriate bottom-up driver of Eliso's revenues. Eliso's market share of US retail and food sales, GMV per average active customer account, Eliso's revenue as a function of GDP growth. Sir, B, sir, because other
B
two are.
is the only one.
Uh,
Other are top down. Yes, B is the only one. Okay. Operating profitability and working. We have studied a lot in financial statement analysis, operating profitability. So I will be fast here. It is the same concept. Nothing. Now, how, and it is economics as well, little bit, that what kind of cost. Okay, let's go down. There was nothing new. The IFRS classification of costs. So this in financial statement we had studied that what is operating cost, what is and we had studied operating cash flow, investing cash flow, and financing cash flow. So interest cost is the financing cash flow part of financing. So it will not be part of operating cost. So let's see. Here is the summary of operating cost. Categorization of operating cost. Variable cost means, okay, one is with behavior and output. We didn't study this part in financial study. We studied this part in economics. Well, we have not studied economics. We studied prerequisite to economics, I think. So, behavior with output. So, variable cost varies with output. You know it very well for years. And fixed cost doesn't vary with output. It is fixed. So, average fixed cost keeps on declining. So, one way of categorization of operating cost based on economic principle or behavior with output. Second is nature, what the cost is. Compensation of employees, this was from financial statement, SGA. Then raw material, cost of goods sold, that was also from financial statement. Merchandise means inventories cost, and office supplies, that is another operating cost. So all these are by nature. These are operating cost by nature in financial statements. We will write these as names in the income statement. We will write these names on the left side and put the values opposite it. By function, cost of goods sold. This also we write. So this was part, okay. Raw material and cost of goods sold is the same thing actually. This one matches this. Sales and marketing. Okay, this one is additional cost, that is compensation to employees. Yes, it can be part of this because salespeople are also employees. So compensation to employees, it becomes this part and this part. General and administrative, this part only. It will be this part. So this part, this becomes this part also. General and administrative because they are also employed. Research and development. Okay, well, this is just another part of operating. It is operating cost. Yes, research and development is also operating cost. Somewhere when we had this information technology, it was not fully operating because operating cost is expensed, and research and development was spent over time. Do you remember that in technology? So if,
So,
yeah, I remember that research and development was operating. If it is expensed, entire research and development, then it becomes operating cost.
yes,
And
sir.
yeah, I remember, and if it is carried over time, then it is no longer operating cost.
Yes, sir. Yes, sir.
Yeah, it becomes investing part. So fixed and variable cost, operating profit as per this. Yeah, so Q, quantity times price minus variable cost. This is variable cost and minus fixed cost. That is operating profit as per variable cost and fixed cost. This you have been studying in economics for years. And then this one is QP total revenue and minus QC was the QVC variable cost and QFC fixed cost. It is called contribution margin. The price P minus VC, or it is called contribution margin and must be positive. And rest of the things are very much clear. So P minus VC is contribution margin. So that is one new term. And the next term is about degree of operating leverage. So how is this shown? This is shown as percentage of change in operating profit. Okay. So this one is change. Percentage delta operating means it we have to compare with two periods. Then only we can find change. Otherwise, what will operating profit in period quarter one, then operating profit in quarter two, and what was the percentage change in operating profit? Means if it was 20% in first quarter, in second quarter it became 22%, then percentage change was 10%. Means 22 by 20 minus 1. So percentage change in operating profit divided by percentage change in sales. So it is not taking absolute, but percentage change that as the company increase means marginal. Okay, you can tell it marginal operating profit by marginal sales. That is what it is. Marginal operating profit. That is what you can say, no, because it is sales. So DOC divided by DOP, delta operating profit divided by delta sales, DS. DOPS by DS is the degree of operating leverage. So let me write it so that it is easy to remember with marginal cost. So DOPS, OP divided by DS. Yeah. So that is our degree of operating leverage. Variable and fixed cost analysis, no need. Production cost. Okay, so here is the question. If you want, since this is close by, so we will be able to solve it. Read it.
Raven's contribution margin per barrel for the last 12 months is closest to.
Okay, so let's look at the contribution. Contribution margin means P minus VC. Contribution margin was what? We had said right now, no? P minus VC. This was our P minus.
Minus.
Yes, P minus VC. This was our contribution margin. So let's see what is the production cost per barrel. So this one is VC. This one is next 12 months. What was last 12 months? 17.24. This one was the production cost, variable cost, that is the production cost. And what was the price? Let's see, price. So we see is, and here is the price. Average price per barrel is 49.66. So 49.66 minus
17.24.
17.24. So that would be 32.4 B. Yeah, B the correct answer. That was our contribution margin, P minus. So this is the new term that you learned. What is contribution margin? So that in the exam, if it comes, you should be able to remember it. Contribution margin, P minus VC. Okay. Then what is the next question?
Sir, why is it called contribution margin, sir?
Oh, because it is contributing to profit. So that's what is called contribution. It is margin is profit. So it
Yes,
is
sir.
contribution from variable cost.
Oh, so anything above the variable cost, how much we earn, that is the profit. So when we subtract the price minus that, that's the contribution.
Contribution margin, yes.
Okay. Sir, is there any margin for fixed cost also?
The margin for fixed cost. Well, if they ask for separately for it should
That would be the
completely
shutdown.
possible.
That should be
Huh?
shutdown point. That should be shutdown margin. No, sir.
That should be sub down. Yeah, with the fixed cost is well in the short run it will not. It is not. Nobody cares. So the firm doesn't care about the fixed run. Variable average variable cost it cover. It cares that if it is not if the contribution margin is zero, then the firm will shut down.
Sure. Okay. Okay.
Yeah. Okay. Question B. 2.
At the high end of management's guidance, Ribbon's operating profit for the next 12 months is closest to.
Okay, so it will be formula that what is the high end. So this part is actually high end. So what is the management estimate price of high end? Here, sales volume production. So for next 12 months, no here. At the time guidance was provided, the average oil price was 62.50. So this was the guidance that was provided. So they expect that sales will be lowest this much, and this one is the high end sales because it is for next 12 months.
So guidance is like the forecast.
But guidance is a forecast, yes.
Okay.
Guidance means forecast, yes. Guidance means forecast, and the price will remain, the cost will remain the same, 17.34. What will be the price? 62.50 was the price, but is there any price guidance also? Probably no, because cost is only 10 cents higher. Other operating expenses and SGA, so these are the other expenses, but what is the question? Does it need? So quantity should be 160, 197 for this part. Okay.
Sir, why not the lower end, sir? Why?
Oh, because the question is high end. No, this question. There will
Okay.
be lower end question also.
Okay.
So here at the high end of management guidance,
Okay.
operating profit. So quantity should be 167 and times operating profit, EBIT. Operating profit is EBIT. So what will it include? Since it is asking EBIT. Okay. EBIT. And that one is equal to sales, total sales, means total revenue. So TR minus cost of goods sold, so COGS, and minus that no EBIT. So earning before minus appreciation, this depreciation and other SGA. So minus SGA minus depreciation and amortization. Then we get EBIT, because first we get EBITDA, then we get a gross profit. So this one becomes a gross profit, and if any SGA, then we will deduct that. So let's see. So how much will be the total revenue, which is equal to 167, 197, and price is 62.50. 197. That was the price.
Sir, that is the volume. Okay.
That is so that will be the total revenue, no?
Okay.
This is our total revenue
Sir.
minus cost of goods sold. Okay, so cost of goods sold, why not to deduct it from here? So so that I have to make only one multiplication. So minus cost of goods sold will be 17.34. Okay. And minus, is there any contribution? Depreciation, okay. So here it is 1450 and SGA is 150. Okay. So we will deduct these also. So minus
Sir,
one.
SGA is what's the full form?
Selling and general administration.
General administration.
Yeah. So whatever you give money to salespeople, means they will go and sell. Then they charge
Okay.
DA and they charge some commission. No. So that is
Yes,
SGA. Selling and general administration minus what was the depreciation? 1415. Okay. So this will be our value. Now can you calculate 1450? So what should be the answer?
Yes, sir, calculating. Yes, sir.
Okay.
Sir, 5986.
Oh, B. Okay.
Yes, sir.
B is correct. Yeah, it is already B is correct. So this question can be asked in the exam.
Yes, sir. It's a combination of 3-4 concepts.
Yes, 3, 4. So they will ask you this kind of question. Question number 4.
Some analysts covering Ribbon believe that volume will be lower than what management expects, assuming 5% reduction over last year's volume. Ribbon's operating profit for the next 12 months is processed to.
So 5% reduction over last year volume. So what was last year?
Only a Q we have to reduce.
Yeah, that's it. So Q will be how much? How much will be the Q? Last year volume was how much? It was
154 something.
Yeah, very good. So times 0.95 and you will get the answer. So leave it. You are conceptually correct. So
Sir, so will they ask a block of questions like this? So if we get one answer right, then all the other 4 will be.
not so many, 4, at most 3 in a block. Yeah, at most 3. Otherwise, most of the questions, almost the questions are independent. But some at level 2 they definitely ask in block. At level 1, maybe they have changed the syllabus. But at my time, block questions were few. But yeah, they can ask. Since we have in the book, so they can ask. Okay, question number 4.
Ribbon's degree of operating leverage for the next 12 months at the low end of management's guidance is dash at the high end of management guidance. Operating leverage. Sure.
Low end. So here the question. Now you are asking that why did this low end? Why not low end? And here is the low end. Yeah.
Yes, sir.
So Robbins degree of operating leverage for the next 12 months. Operating leverage, and we had said D operating profit by DS, means that was the operating leverage. No, degree of operating leverage. So management is at the high end of management. Degree of, do we need to calculate or we can only simply make a guess? The degree of operating, okay, we can calculate also. So, but since it is the low end, no. So at low end, it will be lower. Because it is at the low end, then profit will be lower. So let's see. It should be lower. Since it is at low end, let's see. C is correct. Higher than, okay. So I was wrong actually. Let's see. So we need to calculate that. And low end of, what is the low end of guidance? Low end next 12 months. Means our formula was D, so not this is small d operating profit divided by DS. Okay. So here it is calculating last 12 months sales and last 12 months operating profit. Okay. So DO operating sales. So we get this sales. Then low end. Oh, okay. It is coming now. In the low end, here will be the next month sales. So DS will be 76, 88, and 97 minus this. And next 12 months operating profit will be 5496. So degree of operating leverage 5496 divided by DOP means 5496 divided by 1244 minus 1 divided by 9773 divided by 7688 minus 1, it comes 1.95. Means we will have to calculate. At high end guidance, this part will remain the same, 768 and 1244. So this becomes 12 month, 167. So this is the net sales. So net sales, this divided by 7688 and 59, so 1.85. Yeah, it is lower. So this operating, so degree of operating leverage is 1.85 is less than 1.95. So it required some work. But you means you have to calculate first this part and then this, and this part means with this and this. It did a calculation. So DOP by DS. So here DOP was 1240. This 5496 minus 1244. Sorry, by 1240. Oh, let's see this way directly. So DOP. Let's see. Let's use this formula. So 5496. 5496 minus 1244. This divided by DS. So our DS was 9773. 9773 minus 7688. Let's see if this works or not. How much do you get? Can you calculate on calculator? Yeah. How much do you get? Do you? Yeah. So how much do you get? This one is equal to.
1 second.
You have to compare that.
Minus 1, 2, 4, divided by 73, 7. 2.03.
2.03. Okay, let's see. And what about the other one? So other one will be this one was what? Operating profit. So operating profit was how much was operating? Yeah, 5986. Okay. So 5986 minus 1244 divided by 10,450. 10,450 minus 7688. Okay. How much do you get?
$1.71.
Yeah, so we get the same answer. That lower and one higher. Now, why are we getting slight difference in calculation? Because we are taking the mid values, and this one is taking. We are taking the entire values, and this one is taking mid value. That is only. So how much did you get? 1.71.
7.1.
Yeah. So we are getting the same answer. Means we will get the higher, but then one is point estimate and one is interval. So we are actually doing interval estimate like elasticity. We are not calculating percentage and percentage of it. So our method is shorter. But if they ask for calculating exact point, then we will have to calculate this as a percentage. So what I will do, if I change it into percentage, I'm just trying to do it so that you remember if you make a mistake. Now, what is the percentage change here? Means 5496 minus 1244 divided by 1244. That will give the percentage change. This I did, okay. I should copy it and then go for another. Control C. And if I try to make it like this, here I will not write percentage because what we did. Okay. So what percentage comes here? In the first case means whatever you get divided by 1244. So that I will do the percentage.
So can you repeat what has to be done?
Yeah, you have to do, since this is the numerator, because you are calculating percentage, so 5496 minus 1244 divided by 1244.
Oh, okay.
So that will give the percentage.
So 3.41.
3.41 means 341%. This divided by, what is the percentage change here? So 9773 minus 7688 divided by 7688.
Sir, 0.271.
0.271. 0.271, no?
Yes, sir.
So this one is giving different result because it will be much more than 3.41 and divided by 0.271 will give 7 times. So percent, okay, let me see. Next 12 months sales. How did it calculate? 97 minus 5495 operating profit. Okay. So degree of operating leverage is 5496 divided by 1244 minus 1 and minus 1. So it is percentage change. Okay. Okay. So 3.41 minus 1, yes. Okay, so 3.41 minus 1. So
Sir, no,
that
sir. This is the same.
percentage change means increase in percentage, yeah. So this becomes 2.41, yeah. So this one become 341 is the value. So increase in value is only 2.41.
So like even in what they have taken, it is 5496 divided by 1244 minus 1, which is nothing but 5496 minus 1244 divided by 1244. It's the same thing that we did.
Something away that we did, yes. So
So
why
3.41 divided by 0.271, I'll see, sir. 3.41 divided by
it will be too much?
0.271.
No, that
Sorry. We should multiply that, sir, not divide.
Is it multiply, no? Why multiply? Okay. It is opposite. Yes. Yeah. 3.41 because this one is in the denominator. This divided by. Is the book wrong? Looks like book is wrong.
Yes.
Book is wrong actually. So let's do this. So how much does it come? 2.41, like whatever the book has done. So this one was
like the book has done means, sir, it's 3.41, sir, not 2.41.
yeah. It is 3.4. Then it gets minus 1. No.
Yes, sir. Like even if it's minus 1, we have done the same thing, sir. So
we have done the same thing. It is 3.41 and divided by
0.271.
Oh, so the book is wrong actually.
So then it's coming to be 12.35.
The book is wrong. Okay. Oh my God. So this one is, let me highlight it with red. That's wrong actually. This one is not correct. So what is the correct value?
So the correct value is 3.
How much? 12 point?
1 second. 12.58.
12.58 is the correct answer. Okay. So this is the correct answer. And what about the other one? How much will this come?
5986 minus 1244 and divided by 1244. Numerator is 3.81.
Okay.
Then
3.81, yes. This divided by
430 minus 7. 0.35, sir.
0.35. So how much does it come? 3.11 to 3 point. So
10.89.
10.89. Okay. So the book is actually big wrong. 10.89. Correct answer is equal to 10.89. So our formula is correct actually. Means we should have this DOPS percentage divided by TS percentage.
Yes, sir.
Yeah, that is what it should be. And this is our correct formula. So let me correct it up also. Since it is percentage change, So degree of operating leverage where I had written, I had written where I had written somewhere about, no, it should be below this, no? Okay. Probably somewhere I had written, I will correct that also. Means I just need to add percentage, that's it. So degree of opera, here it should be this. So here I am D OPS percentage or D percentage, D OPS percent in percentage terms, and this one is DS percentage terms. That's it. So it is the same thing. Okay. So this is our, now it is easy to remember for you because you are a mathematician and economist. So probably percentage delta change. Okay, so it is writing percentage before, but I think in calculus we write it after. Yeah. DOP in percentage term divided by DS percent terms. Hmm. Is there any other question? Okay, natural and functional operating cost classification and measure. Okay, so here is the summary. Gross profit means this we know very well. Revenue minus cost of goods sold is gross profit. Then EBITDA, we deducted depreciation. Where is that? EBITDA. Oh, if we deduct this SGA, then we get EBITDA. And from here, if we deduct DA, depreciation and amortization, then we get EBIT. This we did right now. So this one is measure of operating profitability. Means we can calculate gross profit margin, EBITDA profit margin, and this one is EBIT profit margin or operating profit margin. So same thing that we did in financial statement. That's why, okay, economies of scope. Do you remember that? Because economic scale we discussed right now. Economies of scope means, okay, let's revise it once again. Even if you remember, probably the book will tell you a bit different definition of scope. Yeah. So economies of scope, here it is. Economies of scope refers to a decline in cost per unit as a number of goods, as a number of product or business lines increases. So you're not selling one product, but more than one product, and generally result from shared cost between the product lines. So all the product lines will share the same CEO, same management, and maybe management, total management is the same. Uh, and even though there will be CEO will be the same, there will be only one CEO. Building will be the same. So that way, timing may be different, and so that way the economies of scope happens. So the shared cost between the product lines. So different product lines will share some common costs or some resources, and that will reduce the cost of production of each product line. So that is economies of scope. Um, okay, so when a company has, so how to calculate it? We calculate it empirically by this line. We calculate it empirically by comparing the profitability of an integrated company with that of a stand-alone company. So multinational companies which produce many firms or which produce related products, it can be, it doesn't have to be multinational. If it is producing related goods like oil and vaccine, no, not vaccine, but Vaseline. Oil and Vaseline, they are byproducts. So that will give the economies of scope. About banks, there is example that commercial bank, a bank will have similar offices like found in financial services where there are customer client service, compliance, technology, and back office across commercial banking. So back office will be the same for commercial banking, consumer banking, brokerage, asset management, payment processing, and investment banking. So back office will be the same, shared in the technology will be the same, and reporting will be the same, and of course CEO will be the same. So that is economies of scope. So when a company has more than one line of product, then only economies of scope will come. If it has only one line of product, there will be only economies of scale, but not economies of scope. But when it has more than one line of product, there will be economies of scale as well as economies of scope. Case study about warehouse. Let's see if there is any question. Otherwise, there is no point in reading the detail. Okay, working capital. So about working capital, we had calculated current assets minus current liabilities is the working capital. That is the definition of accounting definition of working capital. So current assets are accounts receivable and current liabilities are accounts payable. So if current liabilities are more than current assets, then we have negative working capital. And current liabilities happen when we are companies like Apple, so that suppliers are willing to lend us more and more, uh, and for a longer period, and our buyers are paying us cash immediately on purchase. So we have lower accounts receivable and higher accounts payable, and that way this working capital is calculated. So whenever we have negative working capital means suppliers are willing to finance our what? Is it operating cost? Yeah, it is part of it will be part of operating cost because it is neither investing nor borrowing. So it will actually reduce operating cost. Question set 1 to 4. Working capital data below 4 again. Elisho marketplace. Okay, let's see what is the question. Operating margin is closest to. Okay, compared with 2000, we will have to go back on this operating. Compared with 2018, Elisho's operating margin. So operating margin means EBIT. EBIT divided by total sales revenue. So let's move forward. Leave this question. Question number 2. What is the most likely explanation for Elisho's improvement in inventory days? Okay, this one is interesting. Inventory days on hand from 2014 to 2000, let's see, days inventory means DOH. Days inventory is here. DOH is, this is improving. Yes, from 37 to 30. So it has gone lower, so it is improving. DSO is days sales outstanding. Means customers are not paying, so this has gone down. Okay, this one is also improving. And days of accounts payable means we are not paying them. So this one has also improving because the higher it is, the better it is. And in this case, the lower it is, the better it is. So DOH plus days sales outstanding and days means we are not paying them. So that will give us our money. Means if we are not paying, then we have cash. So this DSO minus means DOH means what will be this our net inventory or net working capital, net days working. Okay, net working capital. Let me see. Net working capital means first of all we have days of inventory that we have to pay. So DOH. Okay. DOH means we have to invest money on that. Working capital, yeah. And then plus means when we have to give home loan to sellers. So DSO, okay. And then minus, there is no need of parenthesis. DSO. So there is no need of even parenthesis. Means this much cash we are investing. This means our cash gets involved in, and what we are receiving minus DPO is the cash that we are receiving. So that way we will have our net cash, net working cash position, net working capital. That will give us, if it is negative, then this DPO is more than these two, and suppliers are financing us. Okay, so this becomes our formula, net working capital. Okay, so what is the question? Why it is improving? The question, what is the most likely explanation? Means you have to guess. Most likely means you don't have to, you will not find it here. What is the most likely explanation for Elijo's improvement in investment days on hand? So three factors are there. Investment days means inventory is smaller. That's what it is. Cash cycle. Which of these three should be correct? Oh. Means lower inventory. Lower inventory. That means it is not that you have to look at all the three, because here it is telling that why is inventory reducing. That is what lower inventory. DOH, no, it is means days inventory on hand is less. Means your inventory level is reducing.
So that means the profit is increasing also.
So, but there is nothing like profit increasing.
The rising proportion of GMV gross margin value. So like the
then you don't have to keep the inventory. When third, it is the third parties who are putting inventory on your behalf.
Yes, sir.
Yes, so C will be the correct answer. Yes, because more customers paying in cash, that will reduce this DSO. I mean, the days sales outstanding is smaller.
Yes, sir.
It is not inventory.
Yes,
A strong growth in net retail sales.
But that does not talk about the profit. That does not talk about the profit.
Yes. Okay, question 3.
Which of the following expenses are most likely to vary with output? Depreciation, cost of sales, interest expense. Sir, only cost of sales, because
very good. As the output, yes, as the output increases, so much input will increase, means more goods will be purchased, and so cost of sales will go up.
Eliso doesn't disclose gross profit on third-party merchant sales. However, an analyst observes that a competing marketplace platform places 85% gross profit margin on third-party merchant sales. Assuming that Eliso's gross profit margin is similar, what proportion of Eliso's gross profit most likely came from third-party merchant sales in 2019?
Okay.
Sir, if the public data is not available, by comparison with another company, they'll say it, sir. Is that the actual case?
What proportion? No, it is talking about, it is industry. So this one he has given, means the book has given you the industry information. Now, out of this, so the question asking, assuming that Eliso's gross profit margin is similar, means 85%, on which third-party merchant sales, what proportion? So what is the total gross profit? We have to go and calculate the total gross profit, and out of that, what is the contribution from the third-party commission? It is just simple mathematics. So we will have to go back. I don't know on what page number. Yeah. So let's see. So gross profit from third-party margin, 190 times 85%. So this one, 190 we had seen earlier when we were doing that question. So you remember that 190?
Yes, sir.
Yeah, that you remember. Okay. And then total revenue, that was the gross profit. This also, I think, yeah, we had calculated. So the percentage, 162 by 7.6. No, not a big deal. Capital investment and capital structure. So capital structure, debt plus equity. What percentage of debt and what percentage is coming from equity, that determines our capital structure. And so what are the sources of capital? We had 3 cash flows. Cash flow from operating, cash flow from investing, and cash flow from financing. So these 3 sources will be the source of capital. And where will we use it? Okay, so Is there any other source? And right now we discovered that suppliers can be the additional source. Yeah. When we have negative working capital means they are also the source of cash. Though the book didn't write that, but I wrote that because the book wrote here. Net working capital is positive. That is the use of capital. But well, then suppliers, if it is negative, then suppliers are also source of capital. And then apart from these three, this asset disposals were part of our what? Investing. So asset disposal was not separately, debt issuance was part of financing, equity issuance was part of financing, and cash flow from operations means operating cash flow. So this one is operating cash flow. This one, these two are financing, and asset disposal is investing. Okay. And suppliers are additional, which the book discussed, but it didn't write. So I added that. So we can write 4 sources of cash flow to the company. And where does the company use cash flow? So cash on investment at hand means in the balance sheet, we will see that they have some cash in hand. Then net working capital also, if it is positive, then some of the cash will be used. And capital expenditure means equipment, PPE, investment in PPE, then maintenance of that, and if any additional purchase or acquisitions also, acquisitions, then debt pay down and dividend pay down. So share repurchase is the same as dividend payout. Okay. So this one is the case study. So we will go back here. So here this company is using cash flow from operations. Oh, okay, 90% of its cash flow is coming from operations and only 10% is the debt. Now, how much is the share repurchases? It uses some percent, then increase in cash on investment on balance sheet, means cash balance increases, and then dividend paid is related, and capital expenditure. So that is where it uses. So it is just a case study, nothing to remember here. Evaluating capital investment and capital structure. So degree of financial leverage we had studied. And as the loan increases, our company becomes more risky, it is more leveraged, and that way the degree of financial leverage we can measure means total assets of the company divided by total equity. That was one measure of degree of financial leverage as per DuPont, but there can be another as well if we don't have that information. So what we have, this kind of information, delta percentage change in net income divided by delta percentage change in operating income. So net income by operating income percentage change. That gives us degree of financial leverage. So this one is actually a new definition which was not there in financial statement analysis. Is analogous to degree of operating. It is similar to degree of operating leverage, but is determined by financing cost rather than fixed operating cost. So DFL is that. So this we need to another way of remembering degree of financial leverage. So probably you need to remember this formula, but when practicing we will do that. You will easily understand.
Yes, sir. Yes.
Yeah, you will easily understand it, remember it. So let's see, where is there any question? Okay, unlevered returns. Oh, here it is. This DuPont analysis. Return on equity is 18%. This one is net margin, means net income divided by total sales. Yeah, this one is net income by total sales. Let me type it. Net income. Okay, I should write it in net income by, oh well, why to write? You know this very well. So net income divided by total sales, then this will be total sales divided by total average asset. That gives us asset turnover. Total sales divided by total average asset. is this ATO, total average asset or average total asset ATO. Why not to or type it? So this one is net margin, means net income divided by sales or R. Okay, so I should write it in capital. Net income divided by R. And then this one is ATS. So R divided by average total assets. So ATA, average total assets. And this one is equity. So average total assets divided by average equity. Average total assets divided by average equity. That's what I would write. And that way, this is the DuPont analysis, so that this ATS, average total is ATA, it will be ATA. So that this ATA will be cancelled by this ATA, this R will be cancelled by this R, and so which is equal to return on equity, which is equal to NI divided by average equity. Yeah, average equity. That is what this one is. So I should write it here. That is the formula. This is DuPont analysis. And if you make it 5 stage, then here is operating margin times interest burden and times tax burden. So tax burden is, what is this? EBT, earning before taxes. So net income divided by EBT. This one was net income divided by earning before taxes. That was our tax burden. And what was our interest burden? So we have before EBT. So EBT will be earning before taxes divided by EBIT. Yeah. It should be so that, means also to cancel out, no. So net income by EBT. So in the interest burden, EBT will be there. EBT divided by total revenue, and EBT divided by R. Okay, interest burden, yes. EBT. Okay, let me see. What should be that interest burden? EBT, earning before taxes. Then only this and this will cancel, and this divided by EBIT. But then operating margin is EBIT by net income. Very good. Yes. Now it is clear. And then this one will become EBIT divided by R, and this R will be replaced here, so that will cancel out. So operating margin divided by EBIT by R is operating margin. Then EBT by EBIT becomes interest burden, and net income by EBT. So this cancel this cancel this, and net income by R is your net margin. So this gives us net income by R, net margin. Okay, clear? So that way, yeah, that way you can remember. Means it has to be, so means entire DuPont formula is, let me write it, DuPont, so that, because it's very important, DuPont. This one is equal to.
How are you able to recollect all the formulas on time, sir? Like, I know it's experience, but like for the exam, how should I do that, sir? Every day.
That is what I said. No, that you have to get it cancelled, because tax burden means, well, unless you remember the income statement, such as I didn't remember. I just tried to cancel one, such as, okay, net in margin, I have to come here. This you remember, no? Net margin means return on equity is net income by average asset. This you remembered?
Sir, I was not able to exactly recollect, sir. That's the.
Oh, you're not able to? Okay. Because return on income, probably with practice, if you do it only 3-4 times, you will be able to remember it. So I start with tax burden. So tax burden is net income is always there. So net income divided by EBT. Okay.
Yes,
then times EBT will cancel. So I should put it in parenthesis. So next one must be EBT, because then only EBT,
Yes,
EBT will
yes, sir, we will
cancel.
get cancelled. Yes, sir.
Yeah, so I will put here EBT divided by EBIT. That is our interest burden. And then I will have to put EBIT in the top. So EBIT divided by total revenue gives us operating profit. Okay. And then, so EBIT is also cancelled. So now I am left with net income by R, which is our net margin. Yeah, I am left with net income by R because EBIT cancel, EBT cancel. So I am left with which is equal to, should I write it? Which is equal to net income by R. Okay. Then this times R has to be cancelled. So R will be in the top. This divided by asset turnover, total average total assets. So ATA, that gives us asset turnover. It had taken me about, yeah, I had practiced 5, 6, 7 times, or maybe 10 times, 5, 6 times before taking CFA level 1. I must tell you honestly, I had also practiced this, but at my time, these two were not there. In 2006, these two were not there. Only these three were there. So I had practiced it 5, 6 times.
Okay, sir.
Yeah, and then times, then I will have to put ATA in the top. So ATA divided by AE, that is our final. So that is the return on equity, means net income by average equity, and that is how it has been decomposition. So DuPont decomposition should be the better word. Decomposition. This one is very important. You must practice this, and I think you will remember it easily. Not that it is very difficult. If you do it, try to write it tonight yourself. That okay, what is tax? It starts with tax burden, then interest burden, and then you read this in operating profit, and then after operating profit, asset turnover, equity turnover, and that gives us you the return on equity. Okay, try to do it tonight so that you will remember. And this one is very important. At least there will be 2, 3 questions with different combinations of this. Okay, let's go to the next. Again, I will have to go to beginning. Market value of Ellipson equity was this much, and the book value of debt. What was there? Okay, I will try to solve it. Let's say in 2019, the market value of equity was 1178, and the book value of debt was 144. Okay, assuming the cost of debt 5.5%. So this is the rate of interest, and cost of equity is 12%, means as per CAPM or maybe Pharma and French model, whatever, but it is 12%, and tax rate is 24%. So that where will be the tax rate used in calculating WACC? I have in my equity research report, I have calculated WACC where I had deducted tax rate, and price to book P by B is 1. So we have to calculate WACC. WACC is weighted average cost of capital. So let me write the formula. Then it will be very easy for you. WACC. This one is equal to tax ratio. So what I say, percent weight of tax. Percent. Okay, weight of tax divided by tax weight times, since we get income tax, so rebate, so 1 minus T. Oh, sorry, it is interest weight, not tax. It is debt weight. Debt weight times 1 minus tax rate. So 1 minus T means tax rate. And then plus equity. So plus equity weight, and there is no income tax rebate on that. So that will be the, and times the cost. So times cost. Okay. Cost of equity, COE, COE, cost of equity. So what is the total asset? So total asset is since total capital, debt weight which is equal to debt by total capital. So instead of writing debt weight, why not to write debt by total capital? Debt divided by total capital. So that total capital let me total capital capital. Okay, this one is the debt weight total capital. Okay, and total capital and equity weight is equal to equity divided by total capital. So T capital and then this times cost of equity. Okay. So what is our total capital? Total capital becomes 1178 plus 144, which will be 12 and 1322. So that is 144. So walk is equal to, which is equal to 144 divided by 1322. That's what we got. And this times 1 minus t. So this times, how much is t? 24%. So 1 minus t is 0.76 times 0.76. And then plus equity is 1178. 1178 divided by 1322. And this times cost of equity is how much? 12%. So times 0.12. And that way you will get this. Oh, interest rate is 0.55, sorry. So this times 12%. So why not to calculate in percent? So let me put it 12 only. Okay. And this times 5.5. 5.5 is the cost of interest and then times 0.76. Okay. So please calculate on calculator how much do we get. It will be definitely less than 12% because 12% is the cost of equity. So C will not be the answer for sure. We have to choose between A and B.
Yes, sir.
Yeah.
So 11.15.
Very good. So A is the answer. Yeah, which is equal to 11.15. Okay. A is the answer. So that's how you calculate WACC. I have calculated this in my actual equity research report.
Okay, sir.
Discount it, yeah. So you will see it there also. Question number 2. Okay, yeah, please read it.
Why might Leasos WSCC be significantly higher than warehouse clubs WSCC as calculated earlier in the module?
Why might the WACC be significantly higher than warehouse clubs? Okay, so okay, let's see what could be the reason. So if it is, yeah, yes, read all the three. And then we'll see.
Warehouse clubs business model is less risky than e-commerce. Warehouse clubs capital structure degree of financial leverage close to 1. It's less conservative than Elisos. Elisos is an established retailer with an investment grade rating. So that does not affect the
Yes, that
WSCC.
doesn't apply. She doesn't apply. Okay. So B could be the answer, or e-commerce. Warehouse club business model is less risky than e-commerce. Well, what is Ilios business? Ilios business is it has
Through retailers.
retailers. It has this market client as well. No? It has some clients as well, both. Okay, it is just comparing the specific case. So C is not the answer for sure. B looks to be the best answer. Let's see what is the answer. A is correct. Okay, A is the correct answer because we did not actually calculate. So the cost of equity is the compensation that equity investor asks, and if it is more risky, then the cost of equity is 12%. Oh, okay, so it is given actually. So here the answer is actually this 12% was given here, yeah. And so we needed to look at, and we didn't look at, so that's fine. Cost of equity is only 9%. Okay, we did. Degree of financial leverage. Oh, Elisio. Okay, so degree of financial leverage, this we will calculate. So degree of financial leverage is closest to. Let's see what information do we have. Because we saw two formula for degree of financial leverage. One is this ATA by total asset turnover. Yes, degree of financial leverage is total equity, total assets divided by average equity or average total assets by average equity. That is the degree of financial leverage. But we don't have that information. Here we have the information of what kind of information do we have for Illinois? Come on, we'll have to go much up. What kind of information do we have? We have this kind of information, okay? DO, DSO, DSO, okay. So our information is DPO, financial leverage, cash conversion cycle. Okay. So do we have any information for 2019? DSO, DOH, and DPO. Inventory. Okay. So our formula was, we had studied right now, the degree of financial leverage was, we will have to calculate then. Where did that go? Degree of financial. We had this formula right now. It look like this chapter is not written very well, or they modified it and they messed up. Where was that formula? Degree of financial leverage formula. We had actually right now, no? The other formula, degree of financial leverage. And did we go so down? No. Probably, yeah, there was one new formula that I had told you right now. It was days operating times total leverage. It was in the very. I will have to go down. Sorry. Not so okay.
Sir, you can do a control F and search for
DOL, yeah, control F, and the degree of financial. What was it? DO, degree of financial leverage, no? DO.
I think DOL only, sir.
DOL. Where is that one? Yeah. Yes, here. Here it was. That was degree of leverage. Degree of operating leverage. That was degree of operating leverage. Is asking degree of financial leverage, means percent of operating profit. Yes, this we have discussed. Degree of operating profit percentage change. Operating profit percentage change divided by sales percentage change. That is what we had studied about operating leverage. But it was a financial leverage, no? Okay, let me see if I type it here. F, DFL. Here, yes. Degree of financial leverage is percentage change in net income, percentage change divided by percentage change in operating income. Okay, but we don't have that information here also. We were, okay, the chapter is actually ending. So this is the sample question. So
sir, we need to do a beginning question.
yeah, this one was the question. No, degree of financial leverage. So let's see. B is correct. 1.13. How did it calculate? calculated as change in net income. Okay, percentage change in net income divided by this percentage change in operating income. Okay, so to use that information and we can see. Explain why Eliso's ROE differs from return. Okay, from again we will have to compare those two financial statements. Leave that also because it's just simple comparing means the DuPont analysis means net margin times a turnover time equity multiplier. Someone would be one of them would be different. Okay, so what are these differences? So this one is for warehouse club RO is 18%, and this principally results from Eliso's lower net margin. Net income by sales is net margin. So one is net margin, it has 1.3 margin that warehouse, and Eliso has only 1%. So 1% versus 3%, 2% margin, but it is writing 1.3%. What is this? Margin, net income margin for warehouse club is 1.3%. So why it is writing here 1%? It is 1%, okay. And equity multiplier, that is, equity multiplier is 40%, say one, which is somewhat effective. Okay, means we will have to go back and compare the financial statement about, let's go to, okay. So what, should I do that? The first one in the beginning and then I will come back to solve. It is just comparing the this DuPont analysis or DuPont breakdown of two companies. So let's go and do this part one. What we learned so far. This will learning GDP growth. Did we come back too much? Identify the two. Oh yes, here. So this one is already known, analyst investment recommendation and risk. Means recommendation and risk are common to all. Identify that are common to all company research reports, and two elements that are common to initial research report. So initial report, research report is more detailed. So it will have this Michael Porter's analysis as well, the 5-factor industry analysis also.
Then the SWOT and PEST analysis.
Yes, very good. Detailed financial analysis, discussion of issuers, business model, strategy, and explanatory charts, and then industry overview and complete. So this one is Michael Porter's analysis. Okay. Oh, sorry. Yeah, read question number 2.
So identify 3 information sources that analysts commonly use to determine and analyze the company's business model. So whatever is available in the public, so like the filings, then annual reports, quarterly reports.
So quarterly report is the same as filing. No?
Filings, yes, sir.
Then so that is the company report on the website, and that is company. Then
so then
industry report.
Yes, sir. Industry
GDP
report
and industry growth and all those things. And so that one is publicly free available information. And the first one you said is company provided free information. So one was company provided free information, second was public provided free information, and the third one?
So like other investors information.
Yeah, it is private information. Means you may have to purchase it. Other investors information means why will an equity analyst give his analysis to you? So you will have to purchase it, means privately provided information. So regulatory filing, investor events and presentation by the issuer and visiting company properties. These are the 3. Well, it is more than 3. It is asking only 3. Yeah, question 3.
So last year, a distributor of dental care products earned 800 million in revenues. Management estimated that its market share was 10%. Based on the management's estimate, the market size for distribution of dental care products in this geography last year was closest to.
How much will it be?
Sir, 10% of 800. Sir, no, sir. Closest.
It is 10%, and that is equal to 800 million.
So then 8,000 million.
8,000 straightforward answer. Question C. Oh my God, what is so long calculation? Okay, this question, yeah.
A beverage manufacturer recently introduced a new line of healthy tea-based drinks. Average selling price was $20, a case that last year, and the company sold 2 million cases. This year, on analyst forecast sales of 3 million cases. An increase in the average selling price from reduction and discounts and promotions of 5%. The analyst forecast for net sales growth this year over the prior year is closest to.
So net sales revenue growth. Okay, so what was sales revenue last year? 40 million, 20 times 2 million. So last year sales was 40 million. Is this correct?
Yes, sir. Yes, sir. Yes, sir. The company sold 2
And
million
what will
cases.
be this year's sales forecast? 3 million times 3 million from a reduction and the increase in average selling price from a reduction in discount of 5% means this will become 19 because 5% less from discount. So this 20 becomes 19. So 19 times 3, 57. So this will become 40 and 57.
Sir, that's an increase now, sir. Increase of 5%. So it should be.
Increase or what? This year forecast sales of 3 million cases and increase in average selling price from a reduction in discount and promotions.
But ultimately the selling price
Okay,
increases.
from a reduction in discount of 5, it is increase in average selling
Yes,
price.
sir.
So this becomes actually 63, 21. In forecast sales of 3 million increase in average selling price. Yeah. So increase in average selling price of 5%. So this one will become 63 actually, yes. So 63. So 23 by 40. How much will it be? 55% or 58%, I think.
Yes, sir.
23 by 40, 58 C. Let's see.
Yes, sir.
Yeah, C is correct.
Impression Limited is a fictional company that designs, manufactures, sells skincare beauty products. Identify whether each expense line below from Impression's annual income statement is most likely a fixed or variable cost.
Oh, you can easily tell it. Okay. Yeah. So amortization of acquired intangible assets.
So that would be fixed, sir.
Very good. Fixed. Yes. Okay. So I choose fixed. Yes.
The interest also will be fixed, and cost of goods sold that can vary depending on the input. So that cost is variable. Then general and administrative expenses.
That should be variable because it is employee, no?
Employee people, yes, sir. That is a variable.
That should
Sir.
be variable.
Sales commissions,
Sales
that
commission,
is also variable. Yes.
Focus only to interest expense. Well, okay, depends on how much loan.
Sir, if it is a floating rate, then
yeah, then it will be variable also. Yeah, if it is floating rate, then it will be variable. But anyway, economists treat it as interest expense on PPE. So let's put it fixed.
okay.
1 is fixed, 2 is fixed, very good. And 3 is variable, 4 is fixed. SGA, why it is fixed? Are usually not related to sales volume, which means, but SGA includes employees. Okay, I agree that it can be variable also. So let's put it, it can be fixed also. So let's put it
very subjective.
Subjective judgment, yeah. Because it is said no, general and are usually not. Usually not. These are debatable questions. There should be exact question then like this one is fixed. Okay, that's fine. But SGA means you can fire your some manager, some people. It is not that you cannot fire. And variable, okay. So that was something. Question number 6. Oh my God. What does this tell? Based on the below data, the degree of operating leverage for company XYZ. Degree of operating leverage. We had done it right now. That percentage change in sales, percentage change in operating margin divided by percent, that would require a lot of calculation. If so, then we will just see the answer. Yeah, we have to calculate the D percentage change in operating income divided by D percentage change in sales. So that is the formula we needed to remember. So that is the degree of operating leverage, means D operating, since it is operating leverage, it will be operating income percentage change and it has to be divided by sales. So operating income by sales gives us the operating leverage. Question 7.
If a company is reportedly trailing 12 months operating cash flow of 150 million, current assets excluding cash of 40 million, and current liabilities of 60 million, company most likely was inefficient in managing its financing.
So it has 150 million in cash because it has cash flow of 150 million.
Yes, sir.
And then it has 40 million additional assets. So total current assets are 190.
Yes, sir.
And current liability are only 60.
Sir, so it is a good thing, sir.
Good thing.
So only
So
B is the positive answer.
B is the used money working capital, yes. Yeah, B is the only possible answer. Because it cannot file for bankruptcy.
Yes.
And it is not inefficient either. So B is the only correct answer. Question 8.
The company's management may choose not to use financial leverage because the company has investment grade credit rating, high degree of operating leverage, lower net debt to EBITDA ratio than its peers. High degree of operating leverage.
High degree of operating
leverage.
means
Yes, sir.
percentage change in operating income is very high compared to percentage change in sales. So it has a lot of cash, that is what it means. If it is invested, then it should use because that increases the profit. But it says may not choose not to use. So a lower net debt to EBITDA ratio than its peers means that it is safer. So if it is safer, then its cost of capital will be lower. May choose not to use finance. Looks like B looks to be the best answer, but what do you agree to that?
Yes, sir.
Yeah, okay, let's see. Yeah, B is the correct answer. Because it is earning a lot of cash from operating, then why will it go and... Okay, let's go to the end. Oh my God, still... What happened? This chapter was quite long. Now it has come. What is this? Yeah. What is this?
Joshua Hu, a research analyst, is initiating coverage on several companies in the ocean freight shipping industry. Old Ships is a mature company with high fixed costs and high capital expenditure to sales ratio because it owns and operates its own fleet of ships. Clean Yachts is a technologically advanced, sustainable shipyard with focus on specialized repairs and ship construction. Who has compiled the following data for the two companies: degree of financial leverage, degree of operating leverage, asset turnover ratio, DSO, days on hand, then DPO is what, sir?
That payable.
Days payable outstanding.
So if it is smaller, it is better.
Yes, sir.
Means this one is better. And degree of days on inventory on hold. This one is better. Because more payable. No, actually this one is better because it is payable. No, means the longer you pay, the more cash you get. So this one is actually not better. This one is better. Sorry, because they are your suppliers are financing you. So this one is also better actually, and this one is also much better because you are receiving days sales outstanding, means you are receiving cash very quickly, and days payable outstanding means you are not paying them quickly. So like Apple. And asset turnover, yes, okay. Asset turnover means total sales divided by average total assets. Let me type it here so that there is no confusion. Total sales means revenue divided by average total assets. So that is asset turnover. Degree of operating leverage, we had studied D operating leverage, no, D operating income, D operating income percentage divided by DS percentage. That is what we had studied right now. And degree of financial leverage, I again forgot the formula, though it was this total assets divided by average equity. So average equity, that was our average total assets divided by average equity. That was our degree of financial leverage. And the another formula was those multiplication, DFL. Let me type it, Control F, DFL. Oh yeah, where is that? One is this, and where is the other one? Here. Percentage change in net income. Okay, divided by percentage. Okay, it is EBIT actually. Operating income means net income by operating. Okay, so let me write it like this: D, small d, net income percentage divided by D, EBIT percentage. Okay, that is what it is. So let me copy this, Control C, and go back there. It was on, I think, page 256. So I will put this here, Control V. So whichever we get, D percentage change in net income divided by D EBIT percentage. Okay, so now what is the question? Is the question, okay, please read it this, then we will go back.
NewShips, the third company, is a web-based shipping technology platform that connects ship operators such as old ships with customers in a wide variety of industries who need ocean freight shipping. NewShips customer place orders online and pay for freights to be placed on container to any destination in the world. So they're like Amazon. So,
Yeah, they're like Amazon.
NewShips partners like Old Ships provide vessels on both long and short-term charters. In 2019, NewShips platform brokered orders for 900,000 20-foot equivalent units TEU containers in aggregate with an average gross freight rate of 3848 per TEU, 20-foot equivalents. On average, NewShips commission, which it receives as a broker from customers, was 6% of the freight rate. Which
Okay.
of the following is most likely to be an element of huge subsequent reports?
Oh, subsequent report.
Subsequent
Okay.
reports. Okay, sir. So
What will you write in that?
subsequent reports would be one. So it's a summary of changes to the recommendation.
Very good. In subsequent, we write only changes. That's okay. So B is the correct answer. Okay. Yes.
Shipping is a highly cyclical industry. Which of the companies most likely has the most ability to ramp up capacity to meet increased demand for shipping services? So
Amazon.
then, this Amazon, the new ships.
New ships. Because Amazon doesn't have to invest anything.
Yeah, yes, sir. Yes,
So
sir.
it can easily meet in cyclical.
Sir, but for them to execute it, the other two companies should be
Why? Why
available.
only two? It will. It has 100.
Oh, okay. These are just two
Why?
companies.
Why will it take only from these two? Anybody can. It can ask. No. Why these two?
Okay.
Amazon has contract with all over the world.
Okay, sir. Okay.
Yeah.
New ships revenue was closest to what?
Okay, let's calculate. New ships revenue, it was given here, no? This is new ships commission. On an average, new ships which received as a broker from the customer was 6% of freight rate. And what was the freight rate? Freight rate was 3848, and how many freights? Brokered 900,000. So revenue will be 900 times 3848 times 0.06. That will be, this will be equal to 900,000 times 3848 and times 0.06. That will be the revenue.
Sir, 27, 207 million, sir.
Okay, is equal to 207 million. So none is the answer. Huh? This cannot be. So it is in million, 207
Sir,
million.
it is
So A will be the correct
one
answer.
chance.
Yeah, so only A is the correct answer. But
No, sir, it is, I mean, yeah, million, yes, sir.
yeah, it is
200.
million. All are billion. So only A can be the correct answer. Okay, and
Sir, but then what is the mistake, sir?
let's go and see the answer to 3. What is the mistake? A is correct, but what is the problem? What is the answer here? New ship acts as a broker and on 5. Come on.
Sir, printing.
This one is not 5%. This one is actually 6%. So the book is having problem. This one is not 5%. Yeah, this one is 6%. Okay. So this one is actually 6%. So A is correct answer. Same formula. 9 times point, it will be 6%. Okay. So here is the problem. Okay. So A is the correct answer. What about B? B. Did we answer them correctly? Yes, we answered them correctly. Question number 4.
Assuming both companies have similar equity multipliers, old ships is most likely to have. Sir,
Old ship, what is its business model? Assuming both companies similar equity multiplier means total assets divided by average equity is the same. Means leverage is financial leverage is the same. So financial leverage is the same. So old ships, which was clean yards. Degree of financial leverage is 2. Degree of operating leverage is only 1, and this one has 2. So old clean yards is better, no? Operating leverage. What is that? Percentage change in operating profit divided by sales. Yeah, so this one is better actually. The higher is better. And so what was the question? I forgot. Question number 4.
Which is higher ROE or lower?
Well, assuming both companies have similar equity multiplier, old ship is most likely to have a much lower ROE. Oh, no. These ratios, the one below 1, because these are better, no. So old ships will have actually much higher ratios because it is not paying them money to the lenders, to the suppliers, and receiving cash quickly. So definitely it will have much higher revenue. Do you see the point? All these 3 are better of old ships.
Oh, yes, sir.
So then it should have higher ROE.
Yes, sir.
Yeah. So old ship much higher ROE than clean yards. Yes. So C. Question 5.
When conducting company analysis, which of the following is least relevant to determine a company's business model? Company's annual report, no. Comments by management about competing products and substitutes. Industry-wide papers regarding company's product pricing strategy. Comments by management.
Very good. That is an update. That is not industry analysis. So once we do the update, then only it will be.
Old ships cash conversion cycle is higher, similar, lower than clean yards.
Cash conversion cycle, no, it should be lower, no? Old ships. Because all the 3 ratios were better, so lower than clean yards.
Okay.
Yeah, because it is receiving cash very quickly, no? First of all, its cash conversion is negative because it was not paying to the suppliers and receiving quicker. That was 27, and you see, no, here it is receiving in just 27 days. It was negative actually. What will be its cash conversion cycle? No, let's calculate CCC. How to calculate that? CCC. Why am I not able to type? CCC. That will be days of inventory at hand, means 12 plus this DSO minus DPO. So DSO is 27 and minus 55. It is negative actually, which is equal to minus 16. So it is much higher. It is negative. So actually, it is in a very good. I should take it there. Control A, then Control X, and I will paste it there. Cache conversion cycle here. Control V. What? I cannot paste it. What happened? Okay, 16 plus 27 and minus 55. What is happening? Why? Oh, what happened?
Sir, I think your this PDF crashed, sir.
Oh, my PDF has crashed.
Yes, sir.
Oh my God.
Sir, then I think whatever you typed will not be.
Will not be saved. Whatever I type there.
Sir, I think. Sir, you can just close this now, sir. Then yes, sir. That is the only way, sir. So close it now.
Leave it.
Leave. Yes, sir. Leave.
Okay, now open it again.
Open it again. I think it will ask if you want to restore old version.
Okay. So let me open it again, and if I get that would be great. Okay. This happens. I know the CFA level 1. It was about equity investment. So let me open this. Open. Okay, we were here. So whatever I typed was not saved. Okay, but we had matched answer 3. So I will again type it here. This one was B. B. Then this also B. And the last one was, the third one was, we had A. So these 3 we had matched. And this one was C. Much ROE, no? Similar, most likely have a much higher ROE. C. And this we had chosen. When conduct company, which of the following is least relevant? B. And then old ships, cash conversion cycle is lower than clean yards, A. And we had calculated. So we had this formula. That was 16 plus 27 minus 55, which was equal to, sorry, it was not, it was 12. 12, which one was equal to minus 16, which is equal to minus 16. Okay. Then, yeah, question 7.
Okay. The first step in reviewing a company's capital investment is to evaluate management's investments, identifying operation cash flow drivers, determine major uses of cash. Sir, determine the major sources uses of cash.
Okay, yes. So determine the C. Okay, let's go back. So 7 is C, A, B, and 4. C, B, A, C. 4 is B, A, C. 5 is correct. Did I write 4 correctly? What is 4 answer? B is correctly. 4 is B. ROE, return on equity. Oh, yeah. So who is correct? ROE. So old ship has half the degree, and however, since the equity multiplier is the same, ROE must be similar. Oh, okay. This part is okay. So answer is B. We missed this part. Sorry. So this part is actually B, and it is telling that here this one is taking care of. Here this 0.84, this 0.84 and 0.82 is equal to, so 0.84 times 1 times 2 is equal to 0.42 times 2 and times 2, and so both are equal. We should have been careful. We made a mistake because it was asking about ROE, and ROE is financial leverage times operating leverage times asset turnover. So because financial leverage is R, total revenue divided by average total financial leverage. No, financial leverage is average total assets divided by average equity. So it only needed to multiply it. Sorry. So average total assets divided by average equity. Okay, this times this degree of operating leverage, average total assets divided by total sales. Average operating leverage. Operating leverage means, sorry, it should be total sales, means R divided by ATA. Then only they will cancel, no? And then R net income by R. So asset turnover. Oh, this one is actually asset turnover. This one is actually asset turnover. This one is asset turnover. This one is asset turnover. Then what is degree of operating leverage? Degree of operating leverage was EBIT, net income by EBIT. So operating percentage change in net income by EBIT. So actually it multiplied all these three. So net income by total revenue is not actually operating leverage, was net income by total sales. Percentage, okay, yes. Net income divided by R. So this R cancel, this ATA cancel. And that way we have this net income by AE, which is our ROE. So ROE is net income by AE, means average equity. That is what we get ROE. So multiplying these three gives the same number, and so both are equal. We needed to do this work, and we didn't do. Anyway, now I am saving it so that whatever I have written so far, that is saved. And what to do of the others? That got lost. Anyway, so we are meeting tomorrow for next chapter.
Yes, sir.
We studied a lot today.
Yes, sir. Yes, sir.
And what did you follow completely?
Yes, sir. I'll have to rework the formula, sir.
But you followed completely.
Sir, that page